So we'll be looking at working capital management. Okay, working capital management. So for the working capital management, we'll be looking at issues of cash management. Okay, so you can go there, you see a question on cash management. What are the issues under the cash management? So we are going to be looking at the Bormont model. So it's just like the economic, how to, okay, so we'll be looking at the Bormont model. Okay, and we'll be looking at the Miller-Orr model. They are all giving us this thing for what? For how to manage cash. Then we also look at the cash forecast itself, which is the normal one that we have been doing, cash budget. Okay, then we come to inventory management. So the inventory management, how do we manage our inventory? We want to reduce our ordering costs and also our holding costs. So the cost of purchasing is going to be constant, but sometimes they can actually tell you that when you buy a particular quantity, they are going to be giving you a discount. So how do we manage our transportation costs? How do we manage our insurance costs and storage costs? Okay, we are going to be looking at that in the inventory management. And the last one will be receivables management. Okay, for the payables management, there is no more, there's not an issue there. I'm saying that they can actually give you a question where you have all of these issues, and we have solved one question like that, where they are saying that they should go for, they want to finance increments in receivables. They are thinking about using credit purchases, using what? Factoring, and also using bank loan, which they have the compensating balance. We solve a question where we have a compensating balance there. Okay, so the receivables is always about what? Changing your what? Your receivables policy, either introducing a discount or either extending the what? The collection period. So what will be the impact of that on your profit, or they will ask you to advise. So you just have to do that particular one. They can also give you a question where they will ask you to calculate working capital, what? The working capital cycle, or the cash conversion. So like the last sitting question. Okay. So the working capital issues. Okay. So the cash conversion, what? Okay, they can give you a question where they will be asking you that one. What you have to do is that you calculate for your receivables collection period, your inventory turnover period, your payables, what? Your payables payment period. Then you just add and subtract. Okay, how we do this particular one. But this one, the inventory, they can give you 2 or 3 categories of inventories. They can give you finished inventories. Okay, so they can give you finished goods. The question can give you finished goods. Okay, they can give you finished goods. When you are giving finished goods, the finished goods turnover period, or period is calculated as you have your finished goods over here, which will be average finished goods. Okay, you have your finished goods, which is the main inventory, divided by cost of sales. Okay, for finished goods is calculated on cost of sales. What if you are giving work in progress? Okay, what if you are giving work in progress? So the work in progress, if you are giving work in progress, it is calculated as the work in progress divided by cost of production. Okay, so they can give you cost of production. So work in progress divided by cost of production multiplied by 365. What if you are giving raw materials? How do you calculate the period? The conversion period, the raw material conversion period, how do you calculate it? When you are giving raw materials, how do you calculate the period there? I'm giving the work in progress to be cost of production. The finished goods is the one that we do. The inventory over cost of sales multiplied by 365. If you are now giving raw materials, okay, what are you going to be doing, seniors? If you are giving raw materials and you want to calculate the period for this one, how do you calculate it?
Purchases.
Okay, so you do the raw materials over purchases of raw materials. So you do this one on purchases. Okay, multiply by 100. Okay, they can give you something like that. You have to be able to what? To go about that issue. What do I have to say? I wanted to say something again. What? So, okay, we, I hope you can remember that we have learned about issues of overtrading, isn't it?
Yes, we have.
Okay. So they can give you a question where they'll be asking whether the company is overtrading. For you to know whether the company is overtrading, you look at the change in revenue. We have to look at that. So you can calculate change in revenue. Okay. The change in revenue, then the change in the what? Change in payables also. So you calculate change in payables. So you just look for the symptoms of overtrading. We are saying that when the company is overtrading, what is going to happen is that their gross profit margin or their change in revenue is going to be significant as compared to the change in what? In the long term what? Capital. So you look at the change in the what? In the overdraft or in the liability item. So change in the current liabilities. So you can see that they are going to be financing most of the investment through short term than what? Than a long term. Then you also calculate their current ratio. So you look for the current ratio of the company. So you look at the current ratio of the company. If you have, you can look at the acid test ratio. And you can also look at, so you can look at some ratios, calculate some ratios, and use it to conclude. Or they can give you the industry average of the where the entity is operating. They can give you the industry average. So you calculate these ratios and now compare with the industry average. If the entity is having a ratio higher than that one, it's possible that they are over trading. Okay, so you can calculate these ratios and use it to support your answer that they are over trading. They can give you a financial statement and actually ask you whether these entities are over trading. This question will be for 15 marks, both calculation and theory. So the theory, they can throw any question at you. They can ask you for the what the working capital policies. You should state them and explain. They can ask you for the motive of holding cash. They can ask you for when you want to undertake investment, what are the things that you'll be looking at? The most important thing is the risk and the return. So you have the risk, you have the return, and you have the working capital policy of the entity also. Okay. So they can ask you if you want to receive money from what? From your debtors. How do you receive money from debtors? You send them what? A monthly reminder or a frequent reminder about their what? Their debts. And you can also be informing them about it, sending them notice. Okay, once in a while you can call them to remind them of their debts. You can also send them emails as a reminder. You can also what? You can also engage what? A factor to collect your money if the people are not willing to what to pay, and you can also take legal action against them. So they can ask you these questions. It is going to be theory and the what? The practical. So you are going to be calculating and you're also going to be talking about some theory issues there. Or they can decide to examine you on what? On the calculation. So you have to really what? Look at the issues of the working capital area there. Okay. So we are going to be looking at after this, we look at investment appraisal, investment appraisal techniques. Okay. So the investment appraisal techniques, we are going to be looking at the appraisal methods, the basic and advanced. So we'll be looking at the payback period and other issues. Then we also look at the advanced ones, which will be sensitivity analysis, okay, lease or buy, the asset replacement decisions, and other issues, asset replacement decisions. So this one now is also going to be there, but we don't know the marks that they are going to be allocating to this one because it's now combined with what? The time value of money for what? For 20 marks. So I was saying yesterday that they can give you time value of money for 8 marks and this one for 12. Or time value of money for 7 and this one for 13. The examiner who has the choice to what? To do the marks allocation. So then you come to the financial management in the public sector. This is what I will tell you to do now. Okay, I will give you some areas to read on. Okay, so this one will be 10 marks. So they can decide to bring the question, 5 questions on public requirements and 5 questions on the PEFA. So if you come to the PEFA, what are the things that you have to learn? Okay, the notes that I've shared with you, you can see that there are table there. Please forget about that table. It's not important. Okay. So you look at the objectives, or the background, objectives and the background of the what of the PEFA. This one is not what, and the background of what of the PEFA analysis. Then you look at what the benefits. Okay, so the benefit of the PEFA assessment. Benefit of the PEFA assessment, very important. Benefit of PEFA assessment. Okay, so you also look at the sources of information. So where do we get the information for the assessment? So sources of information for the PEFA assessments. Then you also look at the outcomes, the three outcomes. Okay, the three outcome of what? Of orderly what? PFM management, or the public financial management. We have the outcome over there. Okay, the three outcomes there, look at them. Then you also look at the pillars of what? PEFA, the 7 pillars. Okay, then you also look at the issue of value for money. Okay, value for money. If you come to the issues of the public procurement, you look at the principles. You look at the principles. You also look at the methods, and you also look at the disposal procedures. Okay, these are the important things that you have to look at. The methods that you are going to be using to procure what goods or services. So you can read about these ones for your 10 marks. Okay, you can read about those ones for your 10 marks. Okay, let's come to what we are coming to do. Okay, so I have this one over here.
Yeah, what about PPP?
The PPP is under the sources of finance.
No.
Yeah. So okay, so let's start with working capital management. Just, are you there? Just, are you there? Okay, Gordon, help us with the question number 1.
Question 1. Gahunda Investments Limited is a company located in Kigali Investment Center, and its management are interested in holding optimum cash balances during the upcoming period. GIL faces a fixed cost of 5,000 Ghana cedis to obtain new funds. There is a requirement for 12 million Ghana cedis of cash over each period of 1 year for the foreseeable future. The annual interest cost of new funds is 50% per annum. The interest rate earned on short-term securities is 10% per annum. Required. A. Calculate the optimum cash balance to be raised under Investments Limited. B. Determine the number of transactions that will arise each year. C. Compute the cost of making those transactions per annum. And then D. Calculate the opportunity cost of holding cash per annum.
Okay, thank you. So this is about what? What do you think you are going to which method do you think you are going to be using?
Boamon.
Okay. So for this particular method, they haven't examined this one before. Okay. So in the exam, they can give you working capital, they can give you question on cash management, which you have to look at. Okay. So let's come here. So this one, the Boamo model is just like what? The economic order quantity, which they are telling us that we should be able to establish what? Our cash requirements for every transaction, or what is the cash that we are going to be spending in every transaction. So it's just like we should determine our optimal cash size, just like the order quantity whenever we are ordering what goods. So we are going to be looking at the question number one here, which is going to be, we use the Boamo model here. Okay. Oh, sorry. Let me be using the formula together. So I said that I will be using the formula sheet, but I didn't do that. I didn't take you through that one. So let's use this opportunity for that now. Okay, I hope you can see the formula sheet. Let me take you there if you can see the. I hope you can see the formula sheets now.
Yes, sir.
Okay. So okay. So this is the, you can see the Boamo model here, isn't it?
Yes.
Yes, sir.
Okay. You can see that it's different from what you have been using.
Yes, sir.
Okay. But the C over here is just the what? It's just the cash size. The A over here, the two is just here, the two. Okay. The A over here is just the annual what? Annual cash demand. Then the F is the transaction cost. The O over here is the opportunity cost of holding that particular what? That particular cash. So if you see over here, it's the same thing. Okay. The A is the annual cash. The F is the what? Is the transaction cost. Okay. And the O is the opportunity cost of holding onto that particular cash. And you can also see the cash spread over here. Okay. The F is the transaction cost. The S square is over, the X over there is just the standard deviation, but we are looking for variance. So the standard deviation exponent 2. Then this one over here is just the what? It's just the interest. The K is the interest. Okay. The K is the what? Is the interest over there. So we can use this particular one. Okay. If you know the items, the A over here is the annual, and this is the transaction cost. So you don't have to memorize the formula, but you just have to know that which of these items. Okay, the A is what? The F is what? The O is what? So if you know those ones, you can just go there and what? And actually copy this one over there and use. Okay, it doesn't mean that if you use the one that you have been using to is wrong. No. Okay, so let's stick to any of them and we'll move on. So we come to our cash size. Okay, so we come to our cash size over here. So we have been using X. Okay, so let me use the one that we have over here. It doesn't mean that that one is also different. So I'll have the 2 multiplied by A multiplied by F divided by the O. The O is the opportunity cost of holding what? Holding onto that particular cash. Let's come here. You have to learn a new 10 over here. So let me come over here and we'll move on. Okay, so let's come here. What is the annual demand for the cash?
I'm 12 million.
Annual demand is what? 12 million. Sometimes they can give you monthly, you multiply by 12. So our annual demand over here is what? Is 12 million. What is our transaction cost?
5,000.
5,000. Okay. So we come to our A over here is 12 million. Okay. And the F over here is 5,000 per transaction. 5,000 per transaction. Okay. 5,000 per transaction. Then we come to the O. The O is the opportunity cost of holding onto the fund. O is the opportunity cost of holding onto the fund. The opportunity cost is the interest that you are going to be what? You are going to be foregoing when you are what? When you are holding onto that particular amount of money. Let's come here. The annual interest cost of new funds is 15%. The interest rate earned on short-term securities is what? Is 10% per annum. What will be the opportunity cost in terms of percentage?
Ten percent.
15%.
Okay, that is a problem now. Okay, that is a problem now. That is a problem now. The annual interest cost of new funds is what?
15%.
Okay, so the annual interest cost of new funds now is 15%. Okay, so if we are going to be what? If we are going to be giving this amount of money to people, what we are going to be doing is that we are going to be getting 15%, or if we are going for this particular amount of money, we are going to be paying 15%. But what is happening over here? The interest earned on short-term securities. Okay, we need a cash, maybe we need a cash every 2 months. If we need a cash every 2 months, you are not going to be putting the cash there till the 2 months, then you go and pick it. No, you'll be investing it somewhere. You pick the cash somewhere. Those that you know, those that are not needed, those that are not needed, you put it somewhere till you need them. So you are having the cost of capital and the benefit that you are getting. They will invest the what? The short-term one. They will invest it for 10% and get what? Interest on it. At the end of the day, how much are you paying? What is the interest cost at the end of the day between these two? What will be the interest? What will be the net interest? You are obtaining the funds at 15% and you are earning interest of 10% on the short-term securities. What will be the difference?
5%.
That is the 5%. Unless you are not giving, unless you are not giving any other rate. The questions that we have solved, they are all for one particular rate, the rate of obtaining the funds or the rate of investing that particular funds. So we say that since you are keeping all the money, you are not going to be getting any amount of money. So we use that particular rate as a single rate. But if you are giving two rates, one will be the investing rate, one will be the obtaining rate. The entity is going to be investing. So if we are investing, it means that 10% of the money will be settling this particular one. So what is the what? What is the amount that we are going to be paying? That will be 5%. So the difference between the cost of obtaining the funds and then the interest that you are going to be earning. I don't know whether they are going to give you this particular one. Maybe they can choose to give you only one rate. If you're having only one rate, it's either you strike it to get whatever you want to get or not. You just pick that rate and move on. So you have to pay attention. So this is why I've brought these questions to also open your mind to a situation like this. So our interest over there, the cost of holding the funds will be the 15% minus what? The 10%. And that will give us 5%, which is 0.05. Okay, so let's come to our this thing over here. Okay, let's come to, so we have the square root of 2 multiplied by 12 million. Okay, multiply by what? 5,000, or divided by 0.05. What are you getting?
1,1549,193.34.
154.
Hey,
1,549,193.34.
Okay, 193.34. Okay, this will be in Ghana cedis. So this is the what? This is the maximum or the optimal cash balance that they have to what? They have to raise by the management of this one. So anytime that they want to carry out a transaction, they will go and raise this particular amount of money. Anytime that they want to sell security, they will go and raise this amount of money. So this is the amount of money that we are going to be raising. But at the end of the day, we need what? 12 million for the year. We need 12 million for the whole year. So how many times can we sell a security that will be worth for 1 million something? That will be the number of transactions that they're asking you. They tell me the number of transactions that will arise each year. They tell me the number of transactions that will arise each year. How much do we need? What is the annual demand for the cash?
12 million divided by that amount.
Okay, so we need what? 12 million. But every time that we want to sell, our value that we are raising per transaction is this one. So how many times can we raise this amount to get our annual demand, which is the 12 million? So it's just like the order size, the annual demand divided by the economic order quantity. That is the number of transactions. Every transaction you are raising 1 million point something something, and you need what? 12 million for a year. So how many times can you raise this amount of money to get a 12 million? So that is the number of transactions, just like finding the order size under the economic order quantity. So we have our number of transactions over here, number of transactions to be equal to the annual cash or annual demand divided by the what?
The optimum cash.
Okay, which is a C. In this case, which is a C. Okay, but if it should be economic order quantity, it will be annual demand divided by the what? By the order size in units, which is the economic order quantity. So what are we going to be getting here? We'll be getting
7.75.
okay, 12 million divided by 154
154,993.
91.34. That will give us 7 point what?
75.
Okay, 7.75 times. So you do this 7.75 times. For you to be able to get your 12 million, you have to sell the securities worth what? 1,500,000 what? 49,173.34 cedis to raise what? You have to sell it 7 times to be able to raise your 12 million. Okay, let's come to the C. It's not a difficult issue. It's a very simple issue when you are okay with what? Economic order quantity. Okay, compute the cost of making those transactions per annum. So we are doing the transaction how many times?
7.75.
Okay, and every time that we are
multiply by the
transacting,
5,000.
what is the cost that we are incurring anytime that we are selling?
5,000.
Okay,
So you
so
multiply the 0.75 by the 5,000.
that is it. So it's just like finding what? The ordering cost. This is just like finding ordering cost. You know your order size multiplied by the cost per order. So we know our transaction size now to be 7.75. But for every transaction, we are incurring a cost of what? 5,000. So what would be the total cost? So the cost of obtaining those transactions, the cost of carrying out those transactions. It's just calculated like what? How you calculate ordering cost under economic order quantity, under management of inventory. So your annual demand divided by the order size multiplied by what? The cost per order. Okay, so we have 7.75 over here multiply by 5,000. Every transaction is 5,000. What are we getting?
38,750.
38,750.
750.
Okay. So let's come to the D. Okay, the D. What are we having as the D?
Opportunity cost of holding the tax pay and
So what is the opportunity cost of us holding that particular cash? We know that the opportunity cost is the interest that you are not going to be getting if you decide to hold the cash. So that is 5%. So what will happen is that the opportunity cost is just calculated like how you calculate holding cost. Okay. So what you do over here is that you have your optimal size divided by 2. You find the average transaction, average amount for the transaction over the year. Every time we'll be raising a 154. So this will be raised throughout. So let's just find an average. So we find average divided by 2. Then we multiply by the cost of holding. The cost of holding over here is the opportunity cost. So the cost of holding over here is the opportunity cost. So we have our 1,549,193.34 divided by 2 multiplied by 0.05. Okay, let me bring this one somewhere here so that it will be very clear. So we have this figure to be you find the average average size multiplied by the holding cost. The holding cost is the opportunity cost. So 154,9,193.34 divided by 2 multiplied by 0.05. How much are you getting?
38,729.3.
So 30. So we have 38,700.
29 Ghana cedis
Okay.
and 83 pesos.
Okay. So sometimes the question can ask you to find the total cost. The total cost is just the cost of the transaction plus what? The holding cost. That's a very simple one. It's just like the economic order quantity. The same thing that we use. It's not a big deal. It's a very simple exercise. It's a very simple exercise there. So we are done with that one. The 2, Mila O.
A minimum cash balance of 200,000 Ghana cedis is required at Gawunda Investments Limited, and transferring money to or from the bank costs is 500 cedis per transaction. The finance manager performs the inspection of daily cash flow movement over the past few years and suggests that the standard deviation of cash flow should be 30,000 cedis per day. The interest rate is 0.03% per day. Required. By using Miller Orr model of cash management, formulate a decision rule for Gawunda Investments Limited by showing the following. A, the spread between the upper and lower limits. B, upper limits, and C, the 10 points.
Okay. Okay. So you can see that this one, mostly the question that we have solved, they have given you the interest on annually basis, isn't it? The interest has always been given to you in annually basis. I hope you can remember that.
Yes.
The one that we have solved, the interest has always been given to you in. So they will give you the annual interest rate. Then we say that the calculation of the interest rate is based on how the standard deviation is calculated. If it is per day, you have to find per day interest. But this one, the interesting thing over here is that the interest that they are giving to us is per what?
Per day.
Per day. So there's no need for us to divide by 365 again. But in the exam, they can give you an interest rate of 10.95. Okay, this 10.95 is an annual interest rate. So if you are doing your issues on daily basis, it means that you also have to find daily interest rate. So you divide by 365. But this one, they are giving us the interest per day. So there is no need for us to divide by 365 again. But in the normal exam condition, we don't know what will happen. And they will always give you the interest in what? on yearly basis. So you just have to calculate it based on how the standard deviation is being calculated. It's per day. So you also do your interest per day. You also calculate your interest per day. The question will tell you to assume 360 days or 365. If nothing has been said, you just use 365. So you divide the interest rate by 365. But this one they are giving us per day. Okay. So I'll make reference to I will now make reference to the formula sheet so that we can actually be comfortable with the formula sheet. Okay. So we have been using our own in full, which we say it is the spread. The cash spread is 3 multiplied by the transaction cost plus the variance divided by 4 multiplied by what? By the interest rate or exponent 1/3. That's what we have been doing. And that is the one that we have over here. So this is the same thing that they have over here. So if you have question on this spread and they're asking you for the cash spread, what you do is that you can just code this formula. You will come to the formula sheet and code this formula. But you have to know that your F is the transaction cost and this one is the standard deviation. So if we have variance. So since the variance is the square of the standard deviation, that's why they are doing the S square over there as a standard deviation. The down is the what? Is the interest. So we are going to be quoting this one like that to calculate the spread. Even if you are not asked to calculate the spread, you cannot calculate the return point and then the upper limit without calculating the spread. So we have the Miller ORR model. Okay, some will say model. Okay, it depends on where you attend your basic school. Okay, so model, no problem. Okay, let's come to, so we are looking for the spread, isn't it?
Yes.
The spread. So we have the spread between, so the spread is 3 multiplied by, okay, 3 times what? Or 3f s squared over 4k
Or
exponents 1/3. I hope that is fine now.
yes.
Okay, so let's just go to let's go to our question now and determine these issues now. I bring it. So 3 into brackets. Okay, 3 multiplied by what is our transaction cost?
500.
Okay, the transaction cost is 500 Ghana cedis. Okay, our standard deviation is what? 500 rather. So our standard deviation is what?
30,000.
So that will be 30,000 squared, isn't it?
Yes.
Divided by 4 multiplied by what?
0.003.
Okay, change that. That is in percentage. Change it to what? Change it to decimal. So 0.03% divided by 100. I'm having 0.0003.
0.0003.
Okay. So we have 0.0003. Okay. And all of these exponents 1/3. So let's move another step again. Okay. Please, you do the ones in the bracket. You do the exponent over here is affecting this one. So you do all of these ones before you multiply the answer by 3. Okay. Don't use the 3 to multiply this before you do the exponent. No. Do the exponent before you use the answer to multiply the 3. So what are we having for the spread? Another one step. 3 multiplied by what?
104.
3 multiplied by 1.
04. 004.19.
004 points.
19.
Okay. Can someone confirm that for us?
Yeah, it's correct.
So I use the 3 to multiply that now. Then we have the spread.
31
012.
201
312. Okay.
012.
012.5
7.
57. Okay.
7.
Okay. So that is the spread now. So let's come to okay, let me go to the next question. Okay. The next question is
Upper
to
limit.
calculate the upper what?
Limit.
Okay. Upper limit is calculated as what?
The spread.
The minimum plus the spread.
The minimum plus what?
Spread.
Which is the U over here. This is the upper limit. What they are having over here is the upper limit. So the U over here is the upper limit. This one is the lower limit plus the spread. Okay, so you can come here and quote this one, or if you have it in your head, that is fine. Okay, so your upper limit over there, the upper limit over there. So let's come to the B, our upper limit over here. So you can see the U over here, upper limit will give us the L plus the spread, isn't it? Okay.
Yes.
The question will always give you the what? The lower limit. What is the lower limit given to us?
200,000.
200,000 plus 312 12.57. What are we having?
512.
512
012.57.
012.57. Okay, so that is the upper limit. Let's come to C. The return point.
The point.
The return point is calculated as what?
One third of the spread. The lower limit by one third of the spread.
Okay, so the lower limit plus 1/3 of the spread. The lower limit is 200,000, isn't it?
Yes.
Yes.
So plus 1/3 of the spread is the same as this figure. Do you agree?
104.
Okay. So 10400.19. So what are you having?
304.
304.19.
004.
A very simple exercise. Okay. So they mostly this thing, the issue they have examined the spread, the issue with the Miller all. That is mostly they want to examine the what? The issue on the cash management. That is how they mostly go about it. So they will always bring the what? The Miller all model. So you have to be very careful with that one. Okay. They can also ask you to do cash budgets. Okay. They can also ask you to do cash budget. So we are going to be preparing a very simple cash budget. But before that, let's see if we can finish the simple ones that we come and devote our time to the cash budget now. So let's come to the number 4, which is about receivables.
Question 4.
Yeah.
Bamboo Limited is contemplating reviewing its credit policy by introducing a cash discount of 2% for payments made within 10 days of purchase. Additional information. 1. The firm's current average collection period is 30 days. The company makes an annual credit sales of 120,000 units at a unit price of 10 shilling.
It should be 10 cities. Okay. So you can
Alright.
be moving. I will
Okay.
change that.
Variable cost per unit is 6 cedis and average cost per unit is 8 cedis. If the cash discount is initiated, 70% of sales will be on discount and sales will increase by 10%. The average collection period will drop to 15 days. Bad debt expenses currently at 2% of sales will fall to 1%. Total working capital needed will not be affected by the cash discounts. The firm's required return on investment is 12%. Assume no additional capital investment will be necessary. Required. A. Compute the net benefit or net loss arising from review of the credit policy. B. Advise Bamboo Limited on whether or not to introduce a cash discount to its customers. Thank you.
All right. Thank you. Okay, so let's come here. So currently, what is the what? What is the collection period?
$30.
Okay. So they are, what are they saying now? They are saying that they want to issue what?
Discounts.
They want to issue a discount of 2% for payment within 10 days of purchase, isn't it?
Yes.
Okay. And they are saying that if the cash discount is initiated, 70% of the sales will be on discount and sales will increase by 10%. So it means that 70% of the customers will take up the discount, 30% will not take it. Is that correct?
Yes.
Okay. And the average collection period will drop towards
15 days.
the people that are not going to be taking a discount, they will pay within what?
30 days.
No, the people that are not
30
going to be taking a
No.
discount, they will not pay within what?
30
If we are using a discount,
They will pay within 15 days.
they will pay within 15 days. The 30 days is we are not giving any discount. So all of you, whether you pay or you don't pay on time, no discount to you. But if we are not introducing the discount, the people that are not going to be taking a discount will pay within 15 days, and the people that are going to be taking a discount will pay within what?
Within 10
Within
days.
10 days. I hope that is correct. Okay.
Yes.
So the total working capital needed will not be affected by cash discounts. The firm's required return on investment is 12%. So this one, we have to look at this particular one. This particular question is a very simple question. Okay. It's a very, you can see that it's not plenty. And if you are looking at it, you can ignore and say, oh, this is not anything. Please, you don't take your time, it will over you. Let's come here. What is the annual sales for the entity?
120,000 units at 10 cities. So,
At 10 cities, isn't it?
yes.
Okay. What is the variable cost?
6 cities
Per what?
per unit.
And they are giving you average cost per unit.
Average cost per unit is 8 cities.
How do you calculate average cost?
The selling price plus the variable cost divided by 2.
The average, are you sure that is how we calculate average cost per unit? Economics or average cost. How do you calculate average cost?
So, this cost plus variable cost.
Then we do what?
Divided by 2.
No. That's not how we calculate the average cost in economics. How do we calculate average cost per unit? It's not just average
Total
cost.
cost
This is per total cost
divided by quantity.
divided by quantity. Total cost divided by quantity. So senior, it should be total fixed cost plus total variable cost divided by the quantity, not 2. So the average cost is per unit. What are they trying to tell you over here? What can you make out of this particular statement? The third one, variable cost per unit is 6 cities and average cost per unit is 8 cities. What can you make out of this particular note here? It's a very important statement.
Contribution.
Not necessarily contribution.
Cost is part.
So
Fixed cost is what?
it's included in the 8 cities.
So the fixed cost is how much per unit?
2 cities.
That's it. So it means that for every unit that you are selling or you are producing, you are incurring a fixed cost of what? 2 cities per that unit. So since they have given you this information over here, the side that you can take this particular calculation from is to know the impact of or to know your net profit now. Okay, based on your current accounting, based on your current receivable policy, what is your profit? If you now increase or if you now implement a new policy, what will now be the profit? Okay, sometimes what we do is that we just look at the cost associated with with each of the policy and compare. That is a case where you are not giving any information on revenue. You're not giving any information on variable cost. But if you are giving information on variable cost and revenue, the only thing that you have to do is that you have to take it from the perspective of revenue. So currently, what is the revenue or what is the profit that we are making from the current policy? What will be the profit under the proposed policy? So for the receivables, the question is just like a chameleon. One of them, you calculate a cost for the existing policy and the cost for the proposed policy and compare. It means that the information given to you over there is entirely on cost. Okay, it's entirely on cost. One of them, you calculate the cost of the existing policy, and if it is factoring, what is the cost of the factoring? Then you compare. But this one, they have given you information that you can determine what? Profits. So we are going to be doing profits. We are going to be doing what? Profits. We are going to be doing profit under the current policy and a profit under the proposed policy. Then we now what? We now look for the appropriate one. So we compare the two and get the net loss or the net what? The net benefit. So we look at the profit under the current policy. Okay, so we be coming to question number 4, which is Bamboo Limited. Okay, so we look at the current policy. Okay, the current policy, we can actually do it from very simple side, isn't it? Okay, so we can actually do this one from a very simple side, which we don't have to stress ourselves. Okay, you can see that whatever be the case, the quantity will not be different, isn't it?
Yes.
Whatever be the case, the quantity will not be what? Will not be different. Whatever be the case, the quantity will not be what? Will not be different. But something that is going to happen over here, if the cash discount is initiated, 70% of the sales will be on discount, and sales will increase by what?
10%.
Okay, so it means that the quantity that we are going to be selling will now be increasing. So sorry for that. The quantity that we are going to be selling will be what? The quantity that we are going to be selling will be increasing. Is that correct?
Yes.
Yes.
Okay. So let's take it from this perspective. Okay, let's start from contribution, or we should show the revenue one by one. Should we show the revenue variable cost, fixed cost, and those ones, or we should start from contribution?
Contribution.
Okay, let's start from contribution. Contribution will be what? What will be the contribution per unit?
4 cities.
Contribution per unit will be 4 cities, isn't it?
Yes.
Contribution is calculated at the selling price minus variable cost. So selling price per unit is 10, and the variable cost is what? The variable cost is what? Is 6. So the contribution per unit will give us what? 4 cities.
4 cities.
Okay. How many units are we selling?
120.
Okay.
So
So what will be the total contribution?
180,000.
400 and what?
80,000.
Okay, so I have 480 here, isn't it? Okay. So let's come to our fixed cost and other costs. Okay. So let's come to our fixed cost. The fixed cost will be 2 CD multiplied by what? 120,000.
120,000.
And that will give us
240,000.
so 240. What are other costs that we are going to be incurring based on the information that we are having?
Bad debt.
Cost of receivables.
Okay, the cost of receivables will be there, isn't it? But let's deal with this one first. Okay. What are we going to be? What will be the first one that we can actually calculate over here is bad debt, isn't it?
Bad debt. Yes.
Bad debt is currently at what?
2%.
Okay. So bad debt is currently 2% of sales, isn't it?
Yes.
So the current policy now, we are going to be having bad debt. So the bad debt over here will be, bad debt will be 0.02 multiplied by what? What will be the total value of the sales? 1.2 million. Is that correct?
Yes.
Okay. So 1.2 million. What are we having?
24,000.
So that will give us 24, isn't it?
Yes.
Okay. Then we now look at the finance cost. The cost of financing.
24,000.
We are keeping 3 zeros at the top.
Okay.
Okay. So we look at the finance cost now. These receivables will be financed. Mostly we say that the receivables will be financed through what? Through overdraft or any other means. Okay. It will be financed through any other means. So what will be our receivables now? How do we calculate the receivables?
30 on 365.
So 30 on 365 multiplied by the credit sales, isn't it?
Yes.
So
1.2
1.2 million. Okay, multiplied by the what?
0.4%.
4%.
0.12, isn't it?
0.4%.
Yes.
Okay, so the required return on investment is 12%. So instead of us using that particular money to invest in other activities, we are now using it to what? To finance the what? The receivables. Or if you are giving the interest rate or bank overdraft rate, you use any of them that is available. Okay, so we are going to be financing this one for 30 days, and that will give us the 0.12. So what is the cost of the receivables?
11835.62.
118.
35.62.
Oh.
So within 3 zeros,
11.83
11.836.
We are holding 3 zeros.
Yes, so
11.836.
11.836.
11 point, are you sure? I'm getting 118 point something. Or let me try it again.
Yeah, 118,
1.18. No, 1.18.
Let's take it one by one. 30 over 365 multiplied by 1.2, isn't it? Multiplied by,
within 3 zeros is supposed to be multiplied by 1,200.
okay, so it's 11.84.
Yes.
Okay.
Yeah.
So 11.84. So what are we having as the profit now? Contribution will give us 480 minus 240 minus 24 minus 11.84. I'm having 204.16.
204.6.
Okay. So that is a profit under the what? The existing what policy. Let's come to the proposed policy now. Proposed policy. Proposed policy, what will be the new contribution now? Proposed policy, the contribution will be increasing by what?
10%.
The contribution will be increasing by 10%. Is that correct? The existing contribution will be increasing by 10%.
Yes,
Okay. So what are you going to
that'll
be
be
getting?
5 to 8.
5 to
So how?
8.
If the cash discount is initiated, 70% of sales will be on credit and sales will increase by 10%. So if the sales is increasing, contribution will also be increasing.
Okay.
Okay. So let's have the 1.1 multiplied by 120,000. Okay, I'm having 132 multiplied by the contribution, which is 4 cedis. I'm having 1528, isn't it?
Yes.
Okay, so you just increase. What it means is that if the sales is increasing, variable cost will also be increasing in the same proportion. Okay, so you can do, if you want to do it, what will be the new quantity now? The new quantity will now be, it will increase by, so you'll be having 132,000. You'll be selling 132,000 now. It means that you have to produce this one. So the variable cost will still be 6 and the selling price will still be 6, will still be 10. So your contribution is 4. 4 multiplied by this one, that will give you 528. Or just multiply your current contribution by 1.1, or find the increase of 10% on the current contribution and add it to the current contribution. So I'm having 528. Okay. What will happen to the fixed cost? Will the fixed cost be increasing?
No.
No, it will remain the same.
Okay. So the fixed cost will still be the same. I hope that is fine.
Yes.
Okay. What will now happen to our bad debt?
Will reduce.
The bad debt will now be 0.01
0.
multiplied by the new sales value now, isn't it?
Yes.
That will be 1.32 million, isn't it?
Yes.
Okay. The sales will now be increasing by 10%. So you can, the sales for the last year was what? Was
1.2.
1.2 million. So you increase it by the 10%. So now it will now be 1,320,000. I hope that is fine.
Yes.
Yes.
Okay. So 1,300,000 what?
20,000.
13.2.
Okay. What are we getting?
13.2.
13.2.
0.2.
Okay. What are some other costs that we are going to be incurring as a result of what? Of the bad debt. As a result of the new policy. Discount will be coming, isn't it?
Yes.
Okay. The discount now, only 70% of the what? Of the sales will be on discount, isn't it?
Yes.
So we give what discount on only 70%. So what we do over here, your total sale is 132,000. So if you are giving discount on 70%, what will be the discount? What is the discount rate?
2%.
So we have 0.02 multiplied by 0.7 multiplied by 132. I hope that is cool.
Yes.
Okay. So the discount is not given on the full. All the people are not going to be enjoying the discount. Okay. The discount is limited to only what? Only 70% of the sales. The discount is limited to only 70% of the sales. So you find the portion of the sales that will be on discount. The portion of the sales that will be on discount. Then you apply the discount rate on it. What are you getting?
18.48.
18.48. Okay. So we have 18.48, isn't it?
Yes.
Okay. The next cost is what? Is the finance cost.
Finance cost.
Okay.
Yes.
The finance cost will be in two folds. So we'll be doing it one by one. Okay. So let's think through. It will be in two folds. So let's come there. What will be the first one? The first one will be based on what?
Discount within 10 days.
Those who taking the discount.
Okay, those who are taking the discount, isn't it?
Yes.
So we find it on the discount. That will be 10 over what?
365.
365 multiplied by the total sales of 132. This one multiplied by 0.7. I hope you understand.
0.7.
Okay.
Yes.
Multiplied by 0.12. Is that cool?
Yes.
Okay. So the 10 days, those who are going to be paying within 10 days will be only 70%. Okay, so it's just like finding 70% of this one and do the 10 days. What will be the receivable as at now? These people will pay within 10 days. So what will be the receivable as at now? Or what will be the portion of the receivable that we are going to be financing? It's not the total that we are financing. Those who are here to pay, those are the ones that we are going to be financing. So some people are going to be taking 10 days to pay. So we finance them for that particular period now. So 10 over 365 multiplied by the total sales of what? 1,320 multiplied by 70% multiplied by the 0.12. So the remaining people will be what? 15 over what?
365.
365 multiplied by
1,320,000.
1,320,000
Multiplied by 0.3.
0.3.
multiplied by 30% multiplied by 0.
Times 12%.
Okay. How that is fine now. Okay.
Yeah,
We have done these things in class, so we don't need to have a problem. So what is the answer for the first one?
3.04.
So 3.04 for the first one, isn't it?
Yes.
The second one is what?
1.96.
1 point what?
1.95.
1.95, yes.
Okay. So what will be the distance now?
Two five 1.33.
251.
0.33.
Okay. So what will be the net benefits?
Um, 47.17.
47 point what?
17.
Okay. So this one, let's do it in what? That will be 47170, isn't it?
Yes.
We are keeping 3 zeros. Okay. We can also do this from a different perspective. Okay. It's either you do it like this or you do it on a net basis. So let's look at alternative approach. You pick the one that you are okay with. Okay. So we can do the one on the one. The alternative approach always is about what? It's about critical thinking. Okay. What you do now is that you can see that the introduction of the discounts, you look for the benefit that the discount will be bringing. The introduction of the discount will increase our what? Our contribution to how much? It will increase the contribution from 480 to what?
580.
So you look at, so you only take the discount as what? As an item on its own. So what is the benefit that the discount is bringing on its own? We look at the benefits associated with the discount itself and also the cost associated with the discount. So the discount will begin something like 0.1 multiplied by 480. That is the increment in the what? In the contribution. I hope that is correct, which will give us 48. It's not going to
Yes.
be 48. 528 minus
It's
4.
48.
Okay. Would the fees cost be increasing? Would the discount be bringing additional fees cost?
No.
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 So the fees, there's no fees cost associated with that. So we are bringing the what? The benefit of the discount and its associated cost. What will happen to the bad debt?
Reduce.
So you can see that the discount will be having what? A benefit associated with the discount. With the what? With the bad debt. First, the bad debt was 24. Now it reduced to 13.2. That will be a benefit of how much?
10.8.
10.8. Okay. Was there any discount in the first place under the current policy? Were there any discounts?
No.
Okay. But
No.
you can see that our discounts will now be what? Our discounts will now be bringing what? That particular cost. So the discount is a cost that is coming from the discount. So that will now come as a cost, 18.48. Okay. What is the new finance cost? What is the finance cost under the old one? What is our finance cost under the old one?
11.84.
What will be the total finance cost under the what? Under the discount now?
4.99.
4.99.
99.
What is happening there? Is it a decrease or increase?
Decrease.
Decrease of how much?
6.85.
6.85. So you are going to be having reduction in finance costs. That is also a benefit associated with what? With the discounts. So reduction in finance costs. That is
85.
6.85. So what you do now is that you now add all of this one. That is the benefit associated with the discount. 48 plus 10.8 minus 18.48. Then you add the 6.85. If it has me something like 47 point what? 17. So you can do it very simple like this. By doing this very simple like this, you are going to be showing all this working. You are going to calculate the bad debt under that. You want to know the benefit that the discount will be bringing. How do you know the benefit? You look for the benefit that the discount is bringing and its associated cost. It's just like you are selling, currently you are selling to 20 people. You now want to introduce what? You now want to introduce additional what? Additional products. Okay. What is the benefit that additional product will be adding to your existing product? And what is the cost that it will be bringing to it? So you can do it for that particular product alone. You can take the discount on its own. What is the benefit in the discount? The discount will now increase our contribution by 48. If not for the discounts, our contribution will not be increasing by 48. So you take that one as a benefit associated with the discounts because it's coming because of the discounts. Okay. If you are now issuing discounts, your bad debt will now reduce from 24 to 13.2. If not for the discount, would there be a reduction in bad debt? If not for a discount, would there be a reduction in the bad debt? No. So that particular reduction is coming as a result of the discount. So it's a benefit associated with the discount. Currently, you are having a finance cost of 11.84. If you are issuing the discount, your total finance cost will now be this one. The finance cost is reducing as a result of what? The discount. So you find the increase or the net decrease in the finance cost, and that is a benefit. You are only going to be realizing that particular benefit from the introduction of the discount. So that benefit is coming with a discount. The discount itself is incurring a cost of discount. Currently, there is no discount. So this particular discount of 18.48 is a cost associated with the discount. So that must be matched with the benefit that the discount is bringing. That's how we do it. But this one, and whatever be the case, you are going to be doing it what? Whatever be the case, you are going to be doing it what? The same way you do all these calculations. But because this alternative approach is sometimes critical thinking, just do your existing one and then the proposed one and advise them what they should do. Okay. I want to show you how we can calculate this discount on total basis. How we can calculate these two discounts on total basis. This is what we do. Okay. So this is what we do over here. So you calculate what we call the weighted average number of what? This. Okay. You calculate what we call the weighted average number of this. Okay. Weighted average number of this. I don't know whether you have seen this one before. Okay. Weighted average number of this. But for me, I normally recommend the 1 by 1. Okay. The 10 days, these 10 days, the 70% of the people are going to be paying within 10 days, isn't it?
Yes.
Okay, so what you do is that what will be the average days? So you have 0.7 multiplied by 10 days. What are you having? Would that be 7 days on average?
Yes.
Okay, so you have 7 days over here. That is the discount. The remaining people will use 15 days, and 30% of those people will be paying. So we have 0.3 multiplied by 15. What are we having?
4.5.
4 points.
5.
Okay, 4.5 days. In total, how many days are you giving to them? 11.5
11.5.
days. So we do the days over here. So if you want to find your finance cost, this is how you do it. Okay, so you find the average. This will be 11.5 divided by 365 days, multiplied by this particular figure, multiplied by 0.12. What are you getting? You'll be getting closer, something closer to the summation of the two.
4.99.
4.99, which is the same as what? The 2 over here, isn't it?
Yes.
Okay. So this one, 100%. What it means 100% is 10 days. If the people are taking 100% discounts, then they will pay within 10 days. So if they are now taking only 70%, so on average, how many days are we giving to them? It's 7 days. The 100% is the 15 days, but they are only 30% is taken. So what will be the average for those 30% people? So you just calculate the average and just do it. Okay, but if you're not comfortable with this one too, you can just leave it and what? Use the one that you are comfortable with. Okay. the main purpose is to be smart. Okay. Advise Bombo Limited on whether or not to introduce the what? A cash discount to each customers. Should a cash discount be introduced?
Yes.
Yes.
Why?
Because cash discount will bring additional profit.
Okay, so issuing of the discount will increase their existing what? Their existing profit by what? 47.17 thousand or 47,170, isn't it?
Yes.
Okay, let's look at the 5, which is about the cost of inventory. Cost of inventory, I'm suspecting they should bring something like whenever there is a discount, when they are giving you a discount, how do we go about it? Number 5.
Number 5.
Yeah.
Sunozisuki Tea Limited produces a wide range of quality sanitary products, ranging from tissue products to perfume, laundry, bar soap, and detergents. It has been selected as the best made in Ghana selling quality sanitary products. On average, the company has been selling 2,000 units of products, detergents per month. The purchase price per unit of the product is 200 cedis. The cost of placing each order in 5,000 cedis, and the current cost is 10% of the purchase price required.
The cost of placing each order is
It's 5,000
5,000. Yeah, it's
cedis.
supposed to be 5. It's supposed to be each. Okay.
A. Calculate the economic order quantity. B. Calculate the total cost of inventory per annum. C. Calculate the total cost of inventory, assuming that the company has received a discount offer of 1% for purchases of at least 4,500 units per order. D. Using supporting calculations, advise the company on whether to take advantage of the discount offer. Thank you.
Okay, so what is the economic order quantity? Calculate that. Let's go. Okay, so let me refer you to the formula sheet now. So the economic order quantity. Okay, so the economic order quantity is this one. I hope you can see that. That one is the same thing that we have been using, isn't it? Economic order quantity. I hope you can see it.
Yes, sir.
Okay, so the economic order quantity over here, the same thing that we have been using. Okay, but you can see that the purchasing power parity and then the interest rate power, the interest rate what? Parity. You can see that they are using D and F now, isn't it?
Yes.
So the D now is what? The D will be the B that we have been using, isn't it? Okay. So the one that you are comfortable with, you can go and use it over there. Okay. So that is the issue there. So the B will always be the okay, the F should be the base currency and the C should be the counter currency. So the counter currency is always at the top and the base currency is always the currency with the 1. Okay. So I hope you can actually remember that one now. Okay. So calculate the economic order quantity for me. I'm getting something over here.
Please take us back to the question.
Is that?
Please take us back to the question.
Okay, I'm coming. So let me go down there.
I believe the economic order quantity
That's what?
3,464.1.
3,000.
464.1 buys, so approximately 3,464.
Are you sure?
I'm getting one. Yes, sir, confirm.
It's confirmed.
Yes, sir.
Okay. What is your holding cost?
10% of purchase price.
And that will give us what?
20.
That will give us 20. What is your annual demand?
Now the man is 24,000.
24,000. Okay. Multiply by 2. Multiply by 5,000.
500.
Divided by 20. Okay. 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 So let's go with that. Okay. So this one is the question number 5 over here. So you look for your economic order quantity. That will be 2 multiplied by your cost of ordering, multiplied by your annual demand, or divided by the cost of holding. Okay, so we have 2 multiplied by the cost of ordering is what? Is 5,000, isn't it? Our annual demand
Yes.
would be 2,000 multiplied by 12. We are selling what? 2,000 every month. So what will be the annual demand? What will be the annual demand? So that will now give us what? This one. And the cost of holding is 10% of the purchase price. So 0.1 multiplied by 200. Okay, so I'm sure another step will be, or 4 steps will be okay. So what will be the top? If you multiply all the top, what are we having? The top is what? 12 million. I'm getting 240 billion. Is that correct?
240 million.
Okay. Okay, so if you divide, you are now getting what? 34.
34, 61.
Okay, 34, 64.
One.
Forget about the point. Just do it to the nearest unit. Okay, 3464 units, isn't it?
Sir.
Okay, so let's come to, they say you should calculate the total cost of inventory per annum. What will be the total cost? What are the components of the total cost?
The purchase price, ordering cost, and ordering cost.
So we need to calculate our purchase price, isn't it?
Yes.
Purchase price will be 200 multiplied by 24,000, isn't it?
Yes, sir.
Okay, what are we having?
4.8 million.
Okay, 400.
4,000. 800,000.
Okay, so let's go to our ordering cost now. Okay, so let's come to the ordering cost. Ordering cost, we need to know how many orders that we are going to be placing to what? To get a 24,000 units multiplied by 5,000. How that is cool.
Yes.
Okay, what are we having?
34642.
Therefore,
642.
okay, we have 34642. Okay, that we Ghana cedis. We come to the holding cost. Or you forget about the point. Holding cost is what? Will give us a 364 units divided by 2 multiplied
times
by
20.
20. What are we having?
34640.
Okay. 34.
640.
Okay. So we have 34640. So our total cost will now be the purchase price. The purchase price of 4,800,000 plus the ordering cost of what? 34642. And we have the holding cost of what? 640. What will be the total?
486.
4869282.
4869
282.
28.
Mm.
Okay. All right. So that is the total cost under the economic order quantity. Okay. Sometimes they will be giving you what? They will be giving you information on discounts. Okay, let's come here. Calculate the total cost of what? Calculate the total cost of inventory, assuming that the company has received a discount offer of 1% for purchases of at least 4,500 units per order. So what are they telling you now? If you want to take the discount, it means that for every order, you should be taking how many units?
4,500.
2,500.
500.
So this now becomes the what? Their order size, isn't it?
Yes.
Yes.
So this becomes the order size. The economic order quantity, we are only using that to calculate our order size. So how many quantity do we have to go there to take anytime that we are visiting the supplier, so that we can reduce our transportation cost and reduce our storage cost. So we are looking at, okay, anytime that we want to send our workers there to come and bring some of the quantity, some of the goods, how many quantities should they bring on every visit, so that transportation costs will be minimized and the storage costs will also be minimized. That's what we call the economic order quantity. So if you are taking 24,000 units from me, okay, you are not going to be using the 24,000 units in one production process. No, this is what you are going to be using for the whole year. So the question now is, how are you going to be picking these 24,000 units from my workplace? Anytime that you are bringing your car, how many quantity are you coming to take? On every visit, how many quantity are you coming to take? So you want to decide on a quantity that at the end of the day, your transportation cost will be reduced, and your cost of storage will also be reduced. That's what we call the economic order quantity. But the supplier can give you that whenever you are coming, come and take 4,500. I will give you a discount of what? 1%. So you have to evaluate that particular option and see whether it is what? It is going to be what? Financially what? Acceptable to go about it or not. So they are asking us to do, the question cannot ask you to calculate the total cost. They can say that the supplier is currently offering the entity 1% discount for every 4,500 units per order. Advise the entity whether the discount is financially acceptable. How can you do that? You have to compare the existing policy of the entity, which is the economic order quantity that they are using, to the policy, or to the discount that they are giving to them. Calculate the total cost for the two, and now compare which of them is better. So we have calculated the total cost of the economic order quantity. We now count the total cost for the discounts now. So we look at the discount. So we look at the issue of the issue of the discounts. So what will be the purchase price under this one?
0.99.
So they are reducing the selling price by 1%, isn't it?
Yes, sir.
So that will be 0.99 multiplied by 200 multiplied by 24,000. It doesn't change the fact that they will still be buying 24,000. Are you okay with that?
Yes.
Yes,
So
sir.
4,752,000.
So what are we having?
475.
4,
475,000.
okay. So let's come to our ordering cost. Okay, our ordering cost now, it doesn't change the fact that at the end of the day, they will be buying what? 24,000, isn't it?
24,000.
Okay.
Yes.
But every order is 4,500. So how many orders can we
4,500.
do we have to place to get the 24,000?
So 24,000 over 4,500.
5.33.
So this will now be 1,500. 24,000 over this one multiplied by what? It doesn't change the fact that the cost per order will be 5,000, isn't it?
Yes.
Yes.
26,000.
So what are we getting?
667.
26,666.67.
Okay, can we make it 26?
667.
Yes, sir.
The
So the 6 is 3.
The
the
six,
six are
the
3.
6 should be 3, isn't it?
Yeah.
Okay. Looking at it, I realize I'm writing 200 or something. Okay. So let's come to holding cost. So the holding cost now, we are going to be holding on to 4,500 units now, isn't it? Okay.
Yes, sir.
What will
Yes.
happen? What will happen now? There is something that is going to happen over here.
The holding cost is going to increase.
No. The holding cost per unit will do what?
To decrease.
Because the holding cost is on the purchase price. What will be the purchase price under this one now? I'm sure it's 198, isn't it?
It's 198.
Okay,
Yes.
so 10% of 198, what are you going to be having?
It's not
19 point what?
8.
So another way is just reduce the holding cost by the 1%. Because the holding cost is on the purchase price. So if the purchase price is increasing, the holding cost will be increasing. If the purchase price is reducing, the holding cost will be reducing. So that you will now calculate the new purchase price, which is the net of the 1%. That will give us 198 per unit. So the holding cost will now be 10% on that. And that will give us 19.8. Another way of doing that is that since the holding cost is what is on the purchase price, the percentage change in the purchase price will also be the percentage change in the holding price. So that will be 0.99 multiplied by 20. I'm sure you are getting the 19.8 over there, isn't it?
Yes.
Okay, what are you
Yes,
having?
sir.
44,000.
432.
44,
550.
44, 550. So whenever your ordering size is reducing, your holding cost will be what? Will be increasing. Okay. So let's come to our total cost over here. Okay. Our total cost over here. So our total cost will now be purchase price. The purchase price will now be what?
475,000.
52,000. Okay. Ordering
26. This is 7.
66667.
7.
Holding is now what?
44,550.
44,550. What are we having as a total cost?
482,3217.
482,
3217.
3217.
Yes.
Okay. So what is the difference now? Which of them is better?
Proposed policy.
The discount, taking the discount is better, isn't it?
Yes.
Okay. I want to show you how you can do but this one, the question is asking you for the total cost. Sometimes they can ask you to advise whether the discount is financially acceptable. It's the same thing. You just calculate the two costs and find the difference and see which of them is going to be better in terms of cost. They also have a way of doing that particular one, but that is not the focus. If you can actually determine this cost. You determine the cost for each of the what? Each of the two issues and advise the one that is what? They should actually what? Take in that regard. So using supporting calculations, advise the company on whether to take advantage of the discount offer. What are you going to be telling them? Should
They
they take
should,
the discount?
yes, they should accept the discount offer since it will reduce their total cost of inventory by 46065.
Or you have actually calculated the difference, isn't it?
Yes.
Okay. So that is not bad. That is all. Okay. Let's try. So this is all about this one. They can examine your inventory, receivables, cash, and the cash we have to. So the receivables is always about what? The change in policy. How do you tackle it? What is the impact of the new policy? Okay, the current policy now. What is the company? What is the issue under the current policy? What will be the issue under the new policy? You now do the what? The two, and actually come with whatever the company will be doing. Can we do something on? So that will be one. We have 2 hours. So I can actually use the. Okay, let's do something on this theory first. Question number 7.
So, okay. The primary objective of working capital management is to avoid over or under investment in current assets, as a very large amount of funds are blocked in current assets in practical circumstances. Management of working capital ensures that sufficient cash is available to meet day-to-day cash requirements. Maximization of profit is another primary objective of working capital management. The management of working capital involves managing inventories, accounts receivable, accounts payables, and cash. Assume you are the financial director of a company with a large investment program. Required. Discuss the conflicts that might arise among the objectives of working capital management.
Okay, what is a conflict? I hope we have accepted that there is always a conflict between the two objectives, isn't it?
Yes.
Okay, so what is a conflict between them?
Okay, so when the entity holds more cash in order to be liquid, it tends to reduce profits since we would have to invest to gain more profits. Again, when we attempt to make more profits by investing, it also reduces the amount of cash we have in hand.
So in this case, what will happen? The two objectives cannot be ours.
Yes, we cannot meet the two objectives at the same time, so we just have to make a balance between them.
Okay, so that is the conflict that they are talking about. The conflict is what is the issue between them. You cannot be having enough cash at the same time you are want to maximize your profit, because you need to invest the cash to get more profit. Now you are holding onto the cash. You are holding onto a lot of cash. It means that there will not be enough cash for you to invest to maximize your profits. So if you want to, in your attempt to achieve one, the other one will not be achieved because the two of them cannot be achieved at the same time. Okay, that is the issue about the conflict. The two of them cannot be achieved at the same time, because if you want to maximize your profit, it means that you have to reduce your cash, your cash or your available cash. If you want to increase your cash, it means that you have to reduce your investment, and your profit will be reducing. And these two cannot be achieved at the same time. So you only achieve one of them and leave the other one, or you have to achieve a balance between them. Okay. So that is the issue of the conflict that they are talking about. That is what you are going to be saying. That is it. A very simple one. Let's do something on cash budget. Let's do something on cash budget. And let's do something on cash budget and see what will be the issue there. All right. Question number 3.
So please, can you move on?
I'm already there. Then it might be your.
No, I'm seeing the additional information. Okay. Question 3. Paitika Enterprises is in the process of preparing a cash budget for the 4 months starting 1st September 2024. The business produces and sells a single product branded K, whose details are as follows. Direct materials is 5 cedis per unit. Direct labor cost is 10 cedis per unit. Variable overhead is 6 cedis per unit. The selling price per unit is 40 cedis. Additional information. Projected sales and production unit information is provided as follows. So we have the months, the sales in units and production in units. B. Variable overheads are paid in the month that they are occurred. C. Fixed overheads are budgeted at 700,000 cedis per month, which includes depreciation of 100,000 cedis. D. Wages are paid 75% during the month in which they are earned and 25% in the following months. E. Material costs are paid 2 months in arrears. A tax liability of 1,400,000 cedis to be settled in the month of October 2024. A new van will be purchased in the month of September 2024 for 2 million Ghana cedis. The current motor vehicle will be sold in the month of November 2024, and it is expected to fetch 300,000 Ghana cedis from a prospective buyer. The cash balance at the end of the month of August 2024 is expected to be 1 million Ghana cedis. The business makes a monthly cash sale of 5% of total sales in a specific month, while the remainder is on credit, which is settled 1 month after the month of sale. Required. Prepare a cash budget for the month commencing 1st September 2024 to 31st December 2024. I'm done.
You're done.
Next, please.
Okay. So that is a very simple. So this is a very simple issue on the cash budget. It's not a very difficult issue, but how we have to. Okay. So those of you doing management accounting can see that we have. This is just like a similar question we solved the last time, isn't it? Okay. Okay.
Yes, sir.
So let's come to the cash budget here. Although I don't want to do anything on it, but let's see, anything can happen. So the business makes a monthly cash of this one. So we are doing this for what? September to what? Oh, that is too much. That is like 4 months. Okay, well let's see. Let's tackle it and see within 20 minutes we can actually finish that. Okay. So Pedica Enterprise or whatever. Okay. Cash forecast. Cash forecast. Cash forecast for the month of September to what? December, isn't it?
Yes, sir.
Okay, so December here. So we have September. They are not asking us for total, isn't it?
Yes, sir.
So October, November. Then we have the December over here. So we have this, we have the currency sign here, and we move on. Okay, so we have our receipts over here. So we have our receipts. Receipts. So receipt we have cash sales, isn't it?
Yes.
And we have the receivables. Okay. Then maybe might have some proceeds over here. Then we just come here and have payments. Okay. So let's come to our workings somewhere here. So I'm sure this will now be okay for workings. So the workings, the first one, we need to know our revenue, isn't it? So
Yes.
I'll make this one to be cash sales as the first working. Okay. So let's take the first one is, let's just focus on those that we can do very easy and what move on. So we are looking at what? We are looking at the sales. So we are starting from September, isn't it? What are the respective sales what are the respective sales units? What are the units for each of them, each of the months? So you have September,
170,000.
October, November, and December. Okay. So what are the demand?
170,000, 190, 180,
170, 190,
180, 180.
180, 180.
Selling price 46 per unit.
Price is what?
46 per unit.
40 cedis. Okay. Forty. Okay. What will be the total revenue?
The first one is 6,800,000.
6,000,000.
800,000.
Okay.
The second one is 7,600,000.
Okay.
7,200,000.
Okay.
And the same thing.
And the same thing, isn't it?
Yes.
Okay. So what we do is let's keep 3 zeros at the top here. Okay. Okay. So the cash sales will now be 5%, isn't it? Cash sales is 5%.
Yes, sir.
So what are we getting? 5% of each month's sales. What are we getting as the cash sales?
340.
340,000, isn't it?
Yes. Unless you are keeping 3 zeros.
Yeah, in the cash budget, we are keeping it over there. So this will give us what?
38,000.
38,000. So I'm having
326,000.
380,000. Okay, this one give us what?
3,600.
Okay, so we have
360,000.
360,000. This will also be 360, isn't it?
Yeah.
So we come here, our cash sales will be 340,
380,
380,
360,
360, and
360.
360. So can we do the remaining 95% at once? Can we do the remaining 95% at once? I said that the company makes a monthly cash sales of 5% of the total sales in a specific month, while the remainder is on credit, which is settled 1 month after the month of sale. Can we do that one at once? The 95%?
Yes.
Okay. So 95%, you see that
You have to
which
bring
one?
address inside
Which one will be what? August will be receiving what?
September. So we bring address.
Oh, no, you can just do the August somewhere. Okay. So you can just calculate the value for the August. So what is the quantity for the August?
The quantity is 150,000.
Okay, 150,000 multiplied by the 40.
That would be 6 million.
5,700.
Okay, so that will be 6 million, then 95 on that.
5,700.
Okay, so I'm having 5.7 5.7 million. Okay, the 75%, 95% of September will be received in October, isn't it?
Yes.
That will give us how much?
Three, two, three.
32.
Three.
You'll get 6460.
64.
6,460,000.
Okay. 6,460,000. Okay. What about October? We receive in what, November? What are we having?
7,220,000.
7
220,000.
220,000. Okay. November we receive in December.
Same value.
The same value, eh? Okay. So we are done with the sales now. Okay, so we can now go to the receivables now. 5,700. How that is cool? 6,460.
60.
7,220. 7,220. How that is cool now? Are we
So
sure?
please, can you go back to the working?
Are we sure that it will be the same figure?
No.
October.
No.
Like
October is what? October is, it cannot be the same figure. Okay, 0.95 multiplied by 7,600, 7,220, that is in October. So 0.95
So the
multiplied by,
last one is 6840.
yeah, 6840,
yes.
6840, 6840. Because the December will be received in January. Okay, so we have 6840,000. So we have 6840,000. Okay, so we are done with the sales issue with the sales now. We are done with the issues of the sales now. Okay, this is what we are going to be doing. Let's now come to the variable overheads. What are they saying about the variable overheads?
Variable overhead state in that month statement.
So it means that we will start from only September to December. It means that they are paid in that particular month. They are paid instantly. So let's come to the variable overhead cost. Okay, so we come to the second workings will be variable overhead. So variable overhead, we have the month over here, September. Then we have October, November. Then we have December. So we have the production. Okay, they are going to be based on production. So they are going to be based on production, not the sales. So this will be production over here. Production unit is what?
180 for September.
180 for September.
200 for October.
200.
220 for November and December.
220 for November and December. Please, it's not profit or loss that we are doing that you'll be talking about matching concepts. No, this is cash. What is the amount that has been paid in cash? Not the amount that we should charge against the revenue. No, this is cash. This is cash budget. So you look at the rates. What is the rate per unit?
21.
Okay, 21, 21, 21, 21. What is the amount that we're supposed to be getting for each of them?
First one is 3,780,000.
Okay, 3,780,000.
780,000.
The second one is what?
4,200,000.
4,200,000. Okay.
And the third and fourth is 4,620,000.
4,620,000. 4,620,000. So let's go to this one. We count to payment. We have our variable what? Overhead. So the first month will be 3,780, isn't it?
Yes.
The second month will be what? 4,200. Is that correct?
Yes, and the last is 4,620.
4,620 for the two. I hope that is fine now. Okay. So let's go to the next item. The next item. So we are done with the variable overhead now. We are going to be looking at
Please, the variable overhead
a 6. So where did you get the
is
21 from? Or you're answering your own question.
is 6. Sorry.
Okay. So variable overhead. I said, variable overhead alone is 21. Then what is happening? Okay. So 6, 6, 6, 6. The first one will be
So
what?
the first one is 1080,000.
1080,000. Okay. The second one is 1.2 million.
1.2 million.
Okay. The third one is what?
1.320.
Okay. 132,000. So we have the 1080 here, 1,200, 1340, or is 20?
20.
Okay. 1320, and we have 1320 here, isn't it?
Yes, we go to labor.
Okay. So we are paying that in that particular month. Let's come here. Fixed overhead are budgeted at what? 700,000 per month, which includes depreciation of 100,000. So what will be the fixed overhead every month? What will be the cash fixed overhead every month?
600,000.
That will be what?
600,000.
Okay.
600,000.
So we are paying 600,000 every year. Depreciation is a non-cash item. So we have our fixed overheads. Fixed overheads to be what? To be
600.
600 every month. Okay. If they should give you a year, what do? You divide by 12, isn't it?
Yep.
Yeah.
Okay. So you don't have to go there and say the question that you have solved is on monthly basis. Why are they giving you? No? You don't have to do everything before you go there. Okay. Wages are paid 75% during the month in which they are earned and 25% in the following months. Okay, what are they trying to say over there? So 75% of the wages for every month will be paid in that particular month, isn't it? And 25% will be paid the following month, the month following the month in which the wages has been incurred. So it means that 25% of August will be paid in what?
September.
Okay. So we have to calculate the wages itself. So we have to go and calculate the wages itself. Okay. So we come to our third workings. That will be wages or direct labor cost. So we do August, isn't it?
Yes.
September. So we do August, September,
Patience.
October,
Patience.
November, and we have December. Okay. So let's now calculate production. What is the production for each of these months? Okay, let me expand this one small. Let me bring it here small. So we have August, September, October, November, December. Okay, so production for August is what? Wages is also going to be based on production. Production
Hello,
for
excuse me, sir. 150.
Yeah.
Hello, sir.
Yes, please.
The month starts from July.
We are doing this for September to December. That's what the question is asking us to do. Not so the ones that we are going to be including, that's what we are including. So we are doing the cash
Okay.
budget from September to December.
Okay, I thought this is the month in which they will start from July.
No, we are not doing that. We are looking at the amount that we are going to be including. So 25% of August will be received in September. That's why we are including the August.
Okay.
All right. Production for August is what?
150,000.
150,
180.
180,000. Oh, the first one is what? August is
150.
150. Okay.
And then September 180.
So 180,
200.
200,
320. 320.
220, 220. Okay. Their rate is
Labor
what?
cost is 10 cents per unit.
So times this. Per unit, times this. Times this. Times this. Times this. So we come here. What will be the figure? 1.5 million. Okay.
1.8.
We have 1.8 million.
2 million.
2 million.
2.2.
2.2 million.
2.2.
And 2.2 million. Okay. So they say 25%, 75 will be in the months, isn't it?
The mandate is
Okay. So this 75 is not necessary for us because we are not doing August, isn't it?
yes.
So 75%
So
of
1350.
13.
50.
Okay, so we have 1, 3. Okay. So
1,005.
1,005.
Yes.
Okay. And this will give us what?
1,650.
1,000.
650.
650. Okay. The same thing over here, isn't it?
Yes.
Okay. Then we come to 25%. 25% of August is not necessary to us because we are preparing the budget from what? From September. Okay. But we know that 25% of August will be received in September, will be paid in September rather. 0.25. So what are we having for that one?
375.
So we have 375,000. Okay. 25% of September will be paid in what?
October.
Okay. So what are we having for that?
450.
We have 450,000. Okay.
500.
500. And what?
550.
And 550. So we have 550 here. So what will be the total amount that we are going to be paying in each of these months?
The last one is 2,200.
222, isn't it?
Yes.
Okay, this one give us what?
Third one is 2150.
2150. Okay, and this one will give us 19.
1950.
Okay. And this one will give us
1750.
17.
50.
Is it 50 or 55?
50. And
I'm having 1725.
okay, it was 1. Yes, 1755.
Okay. So we now come here and have wages. Okay. So we have 1725. We have
1950.
1950.
1725, 1950.
Okay. Which one again?
21.
20,
21.
50
50,
and
then
2020.
22.
Okay. So let's move on to the next item one by one.
Material.
Okay. So material costs are paid 2 months in what?
In arrears. So
Okay.
July will come.
July will be paid in what? In September, isn't it?
September. Yes.
August will be paid in what?
October.
And September
September
will
will
be
be
paid,
November.
and October in what?
And October will be December.
Okay. So what we are going to be doing over here is we are not
So
going
the
to be doing this
material
for,
cost
we are
in
going to be doing it
October.
for only what? Only July, August, September, October, because we are not going to be paying for November and December, so we don't have to do calculation for those ones. Okay. But if you are coming to do the payment, we look at how you go about it. So material costs are paid 2 months in arrears. So July will be paid in September. So we start from July now. Okay. So we do the workings for July now. So let's come here. So we have 4 material costs. So we have July, September,
July,
October.
August.
Okay, sorry. July, August, September, and October, isn't it?
Yes.
Okay, production is what?
140 for July.
140, 150, 180, and 200, isn't it?
Yes.
Okay, the price is what?
5 cities paying.
5 cities. 5, 5, 5. So what will be the total amount?
700 for July.
700 for July.
Yes.
So we have 700,000 for July.
7,500.
Okay.
750 for
Okay.
9,000.
900 for these people. And the last one will give us 1 million, isn't it?
Yes.
Okay. So we have 750 here. And we have 900 here. And we have the 1 million here. Okay. Okay, let's come here. July will be paid in what?
September.
September,
Okay. August will be paid in what?
October.
October.
And
November. December.
the September will be paid in November, isn't it?
Yes.
Okay. So we have November here, and this will be paid in
And December.
Okay. So let's go there. September will be 700. So we have the material cost here. The material cost. We have 700. We have 750.
750.
900.
900. And then 1,000.
And we have 1,000. How that is cool now, isn't it?
Yes.
Yes.
Okay. So let's come to,
Tax liability.
okay. So we have a tax liability of 1.4 million to be settled in the month of what?
October.
October.
Okay, so we have payment for tax liability. So payments of tax liability. So October will be okay, so that will be 1,400, isn't it?
Yes.
Yes.
Okay, so let's go again. Okay,
New van will be purchased in the month of September for 2 million.
so we are buying this in September, which will be acquisition of van, isn't it?
Yes.
Yes.
So we have acquisition of van. September, how much are we paying?
2,000.
2,000.
Okay. But what will happen later?
You're also
Disposal
selling
of
an old one.
disposal of
300,000.
motor
Okay.
vehicle.
The current motor vehicle shall be sold in month of November 2024. It's expected to fetch what? 300,000.
300,000.
300,000.
So from the perspective of the buyer, so the buyer is going to be paying this one. So we look at proceeds from what? That will be receipt, isn't it?
Yeah, proceeds from motor vehicle.
Okay, so we have proceeds from sale of what? Motor
Motor
vehicle.
vehicle.
That will be in November, isn't it?
Yes.
How much?
300.
300.
Okay. So can we now put our total? I'm not sure we have any other
Yes.
issues there. What is the total?
6040 for September.
Okay.
Six eight four zero
6840.
40.
Okay.
7880
7880
7200.
7200. Okay, so this is our figure here, our figure here, our figure here. So we make it A. Let's go to our total expense, the total expense.
The business board.
Okay, I'm coming in. So let's take it one by one. Which one are you taking?
I'm taking the
September.
first one.
We are taking September. So who is taking October so that we can all have
So
it?
let me check October.
I'm taking the third one.
Okay.
I'm taking
The last one,
I want
isn't
to
it?
say the last one.
Okay. So are we all done with the first page now?
Yes.
Yeah.
Okay, so let's now come here.
So the third one is 4970.
4970
6105. First one.
6105.
05.
Okay. The second one is what?
5. This is 900.
Okay. So let's now find our net cash flow for the year. So we have the B now. So what will be our net cash? Our net cash flow. That will be A minus B. So what are we having for the first one?
So please
The
receipt.
third one. Okay.
Okay.
I hope we have all taken the receipt figures for each of them.
Yes.
So I'm having
Yes.
negative 65 over here,
Positive 940.
positive 940. Okay.
Positive 2910.
2910. Okay. The last one is 2080.
Last one.
Okay, 2080. So what do we have to do over here? Opening balance, isn't it?
Yes.
Yes.
So the
Open
question
balance
has
1,000.
the question has given us opening balance of 1,000. So our closing balance will now be what for the first year?
935.
Okay. That will become opening balance over here, isn't it?
Yes.
Okay, so the total will give us what?
1875.
1875. This will become opening balance over here. That will give us what?
4785.
4785.
85.
Okay. That will become opening stock over here.
6865.
6865. Okay. So that is basically about they haven't examined the cash budget, but anything can happen. So you should be able to do something with this one. Please let's pick some questions on investment appraisal now and see what we can do. Okay. Let's pick some questions on investment appraisal. Then we see what we can do over here. Okay, so take the question 1 on the investment appraisal. We try to see if we can look at the issues of sensitivity analysis, replacement. Okay, so let's see if we can actually try 4 questions on this one. All right.
Investment appraisal techniques. Question 1. The directors of Bandala Limited are reviewing the options relating to a machine that is a key part of the company's production process. Option 1. Replace the machine. The cost of the new machine would be 1,000 million Ghana cedis payable immediately. Maintenance costs will be payable at the end of each year of the project. The first maintenance payment for the new machine is 51 million Ghana cedis, although this is expected to rise by 8% per year. Option 2. Overhaul the existing machine. The alternative to replacement is a complete overhaul of an existing machine, the cost of which will be 650 million Ghana cedis, also payable immediately. This will be classified as capital expenditure. However, under this option, the annual maintenance cost will be higher at 81 million Ghana cedis in year 1, with expected annual increase of 11%. As the new machine is likely to reduce the variable cost, the contribution will be different depending on which machine is used. The contribution from each machine, excluding maintenance costs, is tabulated as follows, with the inflows of funds assumed to be at the end of each year. So we have year 1 to 5, contribution of new machine, and then contribution of overhauled machine. The cost of capital is 12%. Ignore taxation. A. Calculate the net present value of each option. B. Estimate the internal rate of return of each option. C. Interpret the result that you have obtained in BI and BII above and recommend which alternative should be chosen. Thank you.
Okay, I'm coming in. Okay, so they are saying that they're having 2 options, isn't it? Okay. So we are asked to calculate the net present value of each option. Okay, net present value of each option. Okay, so if you want to replace the new machine, the cost of the new machine will be what? 1,000 million payable immediately. This is also going to be initial payment assumed to be paid immediately unless the question is stating otherwise. Maintenance costs will be payable at the end of each year of the project. The first maintenance payment for the new machine is 51, although this is expected to rise 8% per year. So the first payment of the new machine, the first maintenance cost, the first amount that we are going to be paying is 51. That will be at the end of the year. Then year 2 going forward will be increasing by 8%. So we look at the issue of increment 2. So we come to option 2. We want to do overhauling of the machine. Overhaul the existing machine. The alternative to replace is a complete what? Is a complete overhaul of an existing machine, the cost of which will be what? 650 million, also payable immediately. This will be classified as capital expenditure. So the overhauling is a capital expenditure. However, under this option, the annual maintenance cost will be higher at 81 million in year 1, with expected annual increase of what? 11%. As the new machine is likely to reduce the variable cost, the contribution will be different depending on which machine is used. The contribution from each machine, excluding the maintenance cost, is tabulated as follows, with the inflows of funds assumed to be at the end of each year. So contribution of new machine is this one. So let's look at the option 1, which is the new machine. So we deal with what? The option 1, which will be the new machine. So we look at the option 1. So let me just use a full board. So I'll be having the option 1. Option 1. Then we have the cash flow what? Cash flow statements. Okay. So we have our years over here. We have year 0, which is now. We have year 1, year 2, year 3, year 4, and year 5. How is the tax paid? They say we should ignore taxation, isn't it?
Yes, sir.
Okay. So we start with contribution, isn't it? So we start with our contribution. The contribution is assumed to arise at the end of every year. So now there will not be any contribution. Okay, what is the contribution for the first year?
Yeah, they are hanging 3 zeros for the cost.
So what is the contribution for the first year?
310,000.
310,000. Okay. Second year is what?
330,000.
Are they saying any increase in the contribution?
8%.
The contribution, is there any increase in the contribution? Did they say something about a contribution increasing every year?
No.
Okay, so that means that is their nominal value. Okay, so let's come to 300 and what?
330,000.
Okay,
380,000.
380,000,
420,000.
420,000,
440,000.
440,000. So we come to the maintenance cost, because the maintenance cost is not included in the contribution, isn't it? The maintenance cost is what? It's not taken from the contribution. I hope you can see that.
Yes.
Yeah, it is said that.
Okay. There is no issue of depreciation over here because they say we should ignore what? Taxation. So no issue of what? Benefit or tax benefit on depreciation. No issue of working capital, and no issue of working capital, no issue of depreciation, no issue of taxation. Maintenance cost for the first year will give us what?
51,000.
The new machine. Check well. We are doing for the new machine first.
Yes, it's 51,000.
Okay. 3 zeros at the top, isn't it?
Yes.
Okay. So they say the first payment is 51,000. That is the first amount that we are paying. However, this will be what?
Increased by 8%.
Okay, so let's go and do the increase somewhere and bring the figure here. So let's go and do the increase somewhere. So we have our workings over here. So workings. Okay. So we have option 1, maintenance cost for option 1. Okay.
So yes,
We have the years
yes,
over here, and we have the cost over here. So year 2 will give us 51 multiplied by 1.08, isn't it?
yes,
Okay.
Yes,
Year
sir.
3 will give us 51 multiplied by 1.08 exponent 2.
Yes, sir.
yes,
Year 4 will give us 51 multiplied by 1.08 exponent 3. And year 5
Yes,
will
sir.
give us 51.1.08 exponent 4. To the nearest figure, what are we getting?
the first, the year 2 is 550,008.
Okay, 55.08, isn't it?
Yes, sir.
So we have 55080, isn't it?
Yes.
Yes, sir.
So what are we having?
Year
3, 5948.
5948.
486.4.
Yes, sir.
Okay.
5948.
Yes, sir.
So
Yeah, 46425 245.3.
245.
Point 3.
Yeah. Okay.
Yeah, 5 69384.6.
6. Is it 6 8? I'm having
6
6 9
69384.9.
4.9. Okay. 69384.9. How that is confirmed,
0.9.
isn't it?
Yes, sir.
Yeah.
Okay. So what we do over here is we have our cash flow or cash profits. I don't know how you are going to be calling it. The first one will give us what? 31 minus 51.
Minus 20.
I'm having
Mhm.
259,000. Is that correct?
Yes,
Yes.
259,000.
Okay. The second one is what?
Mm.
274920.
Okay. The third one is what?
320513.6.
320.
513.6.
Okay. The fourth one is what?
355754.7.
7.
355
354.
754.7.
754. The last one.
370615.1.
370,615.1. Confirm.
Yes, sir.
Yes.
Okay. So let's count to the initial what? Investment. That's
Initial is
no,
1 million.
that is 10, that is 1 million, isn't it?
Yes.
So that will be 1 million. Okay. So this will be dash, 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 dash. So
We're
let's count.
hanging, we're hanging zeros at the top, so
Yeah.
1,000.
Are you sure? It's 1,000 million.
It's 1,000 million.
Okay,
So now
okay, 1,000 million. Sorry.
So we have our cash flow now. So we have the same figure of 1 million. Then we have 259,000 here. We have 274,920. We have 320,513.6. 355,754.7. 370,615.1. What will be the discount factor?
12%.
So we have 1.00 here. So what will be the first one? What are we having for the first one? Okay, let me show you how to calculate the discount factor now on the formula sheets. Okay,
0.0.
so
Okay.
let me show that now. Sorry, we have to be doing all those things.
So the
Maybe
first one is
let's come here. So this one, even if you are doing the time value of money, if you are doing time value of money, okay, if you are doing time value of money, you see the future value formula. If you are using annuity, if you are using that annuity or future value, the ordinary annuity, you want to find future value, you can also come to this one and calculate this figure. Okay, so look at this one. You can see that present value
interest
interest
factor
factor of 1 cedi per period
per period.
at what? For n period.
12%.
Okay, so what they are doing over here, this is the actual present value of what? This is a discount factor. So 1 cedi of this is a discount factor now. So you can come over here. You can
Okay.
see the 12 under the what?
The 12 is
12%.
0.893.
The 12 is here.
893.
12 is.
79.
There we go.
So 12 is here, isn't it?
Yeah.
So you just count to the 12.
Yes.
So these are the percentage over here, and this is the first year. So if you are looking for 12, this is the first year. This is the second year. This is the third year. This is the fourth year. This is the fifth year. This is the sixth year. So the percentage that you are looking for, you just come here, and down there is the number of years, because you can see the period at this side. So if you are doing 5%, this is the first year, second year, third year, fourth year, and the fifth year. So we can pick it from the 12% there, where they are punching the calculator. So 0.893,
893.
0.797.
787.
So let's go there. I'll come and show you annuity factor to 0.893.
0.797.
Okay,
0.712.
0.712.
712.
636.
0.63.
636.
Okay, the last one is what?
0.567.
567.
Okay. So you can now calculate your present values now. Okay, let me show annuity over here too. Let's show the annuity over here too. So this is the present value. This is a discount factor. So if you want to get it, that is one. They will always give you the annuity too. The following one will be the annuity. Okay, present value of interest factor of 1 cedi. No, this will be
They
future
have
value.
the annuity of present value is not pi. I think it's the future value rather.
Oh no,
The future
they
value,
have the
that's what-
two.
Oh, okay.
Okay. So it's the same thing that the person captured. So the person captured one side twice.
Yeah, it is in twice. It is in twice.
The present value is twice.
In the question paper, that's why it is.
Yeah, it is
No,
in
but
twice.
mostly the annuity should be the second one. So maybe
But in
someone
the question paper,
someone should draw their attention to it. Someone should draw their attention to it.
yeah,
So it's
I think
supposed
they make
to be
some mistake.
this supposed to be
To be the annuity, but it's
yes.
not there.
Yeah, they should draw their attention to, because the time that we were doing it, for me, I have the first one will always be the present value, then the present value of annuity, then we have the future value for just a period and also annuity. Okay, so this one they should always give you. So you can see that the one that should follow is annuity. So it was a mistake. Someone should draw their attention to it. I didn't check. Someone should draw their attention to it. So you can see that they are now giving the future value of what? Of ordinary annuity. Future value of ordinary annuity. So this particular one, this is what you are going to be doing over here. You can see that we have a certain formula like this. 1 plus R exponent n minus 1 all divided by R. I hope you can remember this one when you are doing ordinary annuity, future value. Can you remember this?
Yes.
Okay.
Yes, sir.
This is a table over here for ordinary annuity. Okay, but if you are doing what? If you are doing annuity due, it will always be 1 plus the R multiplied by this figure, isn't it? And the future value will be the what? Will be the second one. So that is it. So you can actually come to this one and dictate this particular without punching the calculator. Someone should draw their attention to it. The second one should be the what? Okay. So that one should be there. They should draw their attention to it. It's a mistake that they are doing over there. It should follow this particular figure. It should follow this one. It should follow that one. Then the second one is supposed to be present value of annuity. It should be present value of annuity. The present value of annuity, not. So it's a mistake. They have to draw their attention.
Yeah. So unless you add up, if you want to get a annuity, unless you add up the single ones for the if it's 6 years, maybe you add to 6 years to get the annuity.
Oh, okay. Like me, I didn't check, but maybe the meeting we should have just tell them that so that they will work on it. Maybe they will. You see, they have just copied this particular one. Okay, they will just copy this one too again. So it's something that they have somewhere. Then they will just copy and come and paste at the back of. So it is the same thing that you are going to be seeing in the next one, unless someone has drawn their attention to it. So we are going to be having the 1 million.
The future value, the same thing that they make.
It's the same thing also. We are all human, so it's normal. Let's move on. So 0.893 multiplied by 259,000. What are we having?
2,287.
2,
31.
1, 287.
219,111.24.
219.
The second one. Yeah.
111. 4.
0.2.
4. 24.
Okay.
Yeah. 228,248.4.
The third one, 228,205.68.
I'm coming in. Okay. 2 what?
228,
228,
205.68.
205.68. Okay. What are we having for
226,
226,
259,
259.99?
0.99,
210, 138.8,
210.
138.8.
Okay. So what are they having
170.
NPV? Are they having NPV of positive or negative?
Yeah, we are leaving to decimal place 0.76.
7. Oh, the approximation is
Yes.
not anything. Anyhow, you approximate it. There's no problem with that one. So let's move on. Let's come to the NPV. Are they having positive or negative? I'm sure it will be positive.
We'll get a positive figure.
Of how much?
If I'm right, 115,002.71.
115,002.71. Yeah,
Someone can also cross check it.
I'm sure it will be positive because the figures
That
are
is
all
correct.
200. Yeah.
Correct.
Okay. So let's do for option 2. Okay. Option 2. Okay. The option 2, this is what we do. So option 2, the same principle. We look at the cash flow statement over here. Okay. The cash flow statement. So they can give you something like this for as a very simple one. So we have years. So 0, 1, 2, 3, 4, 5. So we have our currency here, 3 zeros, 3 zeros, 3 zeros, 3 zeros, 3 zeros, and 3 zeros. So we have our contribution, isn't it? Okay. Contribution for year 1 is what?
260,000.
260. Okay. Second year is what?
200,000.
300,000.
310,000.
310,000.
320.
320.
320, 320.
Yeah.
Okay. They also have maintenance costs, isn't it?
Yeah.
Yeah.
Okay. So what is their maintenance cost
81.
for the first year? Is what?
81,000 in the year 1.
So the subsequent years will be what?
11% increment.
Okay. So you have option 2. We have the years now. Then we have the maintenance cost here. So we have year 2 will be 81,000 multiplied by 1.11, isn't it?
Yes.
What are we having?
89,903.
Okay. 1.11 exponent to year 4, 81,000.1.11 exponent 3. And oh, that one also be simple. People are showing levels. Oh, okay. But it's actually simple, but just that maybe you will see that you haven't seen this question before, so you don't know how to go about it. Okay. So just complete that one. So complete it, no problem. Let's now deal with complicated issues now. Okay. So let's see we can deal with some complicated issues over there. Okay. So you can complete that one. Okay. I hope you can calculate internal rate of return for the 2.
Yes.
You use a guess rate. One of them should give you a positive NPV. Then you use that particular one. Senior, take the. Okay, let's do something on the profitability index. Okay. So take the 2 for us. Let's see.
Okay. XYZ Limited is considering 6 projects. You've moved down.
I'm coming in. I want to check some things here. so that we can, because I don't want to waste your time. I don't want to pick a complicated question on MPV, but I'll give you one so that you try. Okay. So, okay, pick that one. Let's see.
Question 6.
Yeah.
Oh, question 2. Okay. XYZ income from 26 investment project with the following details. So we have the project from year 1 to 6, initial outlay, and then we have the new net present value. Additional information. Project 6 is expected to generate the following annual cash.
Yeah, your voice is low.
Okay. Can you hear me now? So project 6 is expected to generate the following annual cash flows. We are given the cash flows for the year 1 to 6. Sales and then costs. Project sales cash flows are exclusive of inflation at a rate of 4% per year for sales income and 5% per year for costs. The cost of capital is 10%. 3. Due to management reluctance to raise additional finance, the capital for investment is currently restricted to 5 million Ghana cedis. 4. Projects 1, 3, 5, and 6 are all independent, but projects 2 and 4 are mutually exclusive. All of the above projects are divisible and none can be delayed or repeated. Required. A. The net present value for project 6. B. The optimum investment combination given the capital constraints. C. The resulting net present value in B above.
All right. So I hope we are done.
Yes, please.
Okay. So this is a question on the, so if they want to bring you question on profitability index, what we call capital rationing. Okay, capital rationing. Capital rationing is that you have a lot of profitable projects, but the money to what? To undertake all of them, you don't have it. So what you have to do is that you have to now pick the project based on the what? On the return that they are going to be giving to you. This particular capital constraint can be through what? Internal sources or the external sources. So we have the soft and then the hard. The soft one is coming from the what? The internal sources. The internal sources will be like the shareholders are not willing to what? Or the shareholders are limiting the what? Are limiting the kind of investment that you have to undertake. Or the entity is not willing to what? To go for additional loan or issue shares. So whatever is going to be having the constraint on the what? On the investment is something internally. So they can ask you for okay. So the capital constraint over there can be something that is coming from internal. It's internal sources. So we call it a soft what? Soft rationing, soft capital rationing. The external one is those things that are going to be what? There is a restriction on the capital that you have to raise because of external sources, things that are outside the control of the entity. So the government can actually what? Place restriction on how many capital it should what? It should be what? It should be raising. The government can actually place restriction on what? On raising some or issuing of what? Equity shares or bond. The bank will also feel reluctant to what? To issue shares to you. So all those issues, all those external issues, that is going to be placing restriction on the investment or the entity, the funds that the entity will need to what? To carry out the project. We call them what? The hard what? The hard capital rationing. So they can ask you about capital rationing. Capital rationing, what we are talking about is that the entity does not have enough funds to undertake the project. We have about 5 projects, which are all profitable projects, but we don't have the required capital to do it. So it means that we are capitally rationed. That is the meaning. We don't have the funds to undertake that. Okay, so they can ask you about theory question on that particular one. But if we are capitally rational, if you are facing the problem of capital rationing, how do we select the project? How do we select the project? It depends on how these projects are going to be behaving. If the projects are divisible, it means that we can put any amount into the project. Then we now select the project based on what we call profitability index. But if the projects are not divisible, we cannot use profitability index. Okay, what we do is that we select a project based on a possible return or the highest possible combination. What will happen is that let's assume that you have 200 million. Okay, you have 200 million. So you have 200 million. You want to undertake two projects. Project A needs what? 100 million. Okay. Project B. So project B needs like, let's say 75 million. Again, project C needs what? Let's see. Project C needs, let's see. Okay, let's say this one needs 50 million. And project D also needs 15 million. Okay. So the question will tell you that these projects are not what? Are not divisible. It means that you cannot what? You cannot undertake parts. But if they see the projects are divisible, you use the profitability index. You look for the return, the percentage of return that each of these projects will be given to you. Okay, then we now rank it based on the what? The percentage of return. But if they say the projects are not divisible, you now pick them based on the what? On the possible what? Possibility. Those are giving you. So you can now select the project like this. If you have the 200 million, if this one is giving you a higher NPV, this is also giving you a higher NPV, you can decide to select BCD, because the BCD, you have to invest fully in each of them. So if you invest BCD, you are going to be investing 175. You cannot use the 25 to undertake the A because it's not what? It's not divisible. It is indivisible. Or you can say, okay, A is giving you a higher NPV. Okay, higher NPV than the 75. What you can do over here is you can do a combination of AB. You cannot do ABC because you need 225. You cannot invest 25 over here. So you can also do ACD. You just do a combination to get the highest what? Highest NPV. Which of these projects will give you the highest NPV so that you can be able to what? You can be able to use the 200 million. So you can pick ACD because this will give you 100, 50, 50. You have exhausted this one. Or you can use AB. You cannot use profitability index if the project is indivisible. So if the project is divisible, we use profitability index. And the question will be telling you that the projects are divisible. Okay, the projects are divisible. They can also tell you the projects are independent. It means that you can undertake them what? Differently. They can say the projects are mutually exclusive. Mutually exclusive means that those two projects cannot be undertaken at the same time. So if A and B are mutually exclusive, what it means that if you are undertaking A, you have to leave B. If you are undertaking B, you have to leave A. That is the meaning of the mutually exclusive. But if they say these projects are dependent, A and B are dependent, it means that undertaking A, you can only achieve A if you undertake B. You can only achieve B when you undertake A. So they depend on one another. So as far as you are undertaking this one, you undertake the second one. It's just like what? Your washroom and the structure. So if you are building a structure somewhere, washroom must be there. So since you are building the structure, you have to put a washroom there. So they are dependent. One project will come out of the other one. So if you're undertaking A, you have to undertake B. That is independent. But if they are saying they are independent, it means that they are individual projects. They don't depend on one another. Okay, so you have to pay attention to those words very well if you are coming to the issue of the capital rationing. Okay, so they are saying that XYZ Limited is considering 6 investment projects with the following details. Mostly they want to examine you on the issue of profitability. They will give you the net present value for all the projects, but they will not give you for one project. They will ask you to calculate it. Okay, and that is the 6 over here. We have to calculate the net present value of the project 6, and they'll give you information on that particular one. So let's come here. Project 6 is expected to generate the following annual cash flows. So we have year 1, 2, 3, 4. The sales is 725, 765, 885, 612. Okay. Project 6 cash flows are exclusive of inflation at the rate of 4% per year for sales income and 5% per year for what? For cost. What it means is that these particular projects are now in what? are now in current terms. We are estimating them in current terms. That is the meaning of it. We are estimating them now in what? In current terms. These figures are in current terms because it is today that we are making these estimates. So we are estimating them in current terms. They are not in nominal value. If they are in nominal value, there is no way we are going to be what? We are going to be increasing them by what? By the 4% and also the what? The 5%. Okay, the cost of capital is 10%. Due to management reluctance to raise additional funds, the capital investment is currently restricted to what? 5 million. Project A, project 1, 3, 5, and 6 are all independent, but projects 2 and 4 are mutually exclusive. All of the above projects are divisible and none can be delayed or repeated. So we are coming to look at the NPV of project 6. That will be the first question. The net present value of what? For project 6. So we come and do the what? The net present value of project 6. That is going to be a very simple one, but you have to pay attention to what? To these particular figures. You have to know that all cash flow that will be given to you when they are giving issue of inflation, it means that they are all estimated in what? In current terms. We are all doing now them today. So let's look at that particular issue over here. So let's look at the cash flow. I'm going to be doing the workings. So let's do working somewhere here, but I'll do project 6 over here. I'll do it in the normal form. So you have project 6 over here. I'll have the years. I'll have my cash flow. I'll have the years. I'll have my cash flow. I don't want to do it like the first one. So I'll have the cash flow. I'll have the present value. I'll have the discount factor. Then I'll have my present value here. Okay, so I'll do it in this form. And before this, I'll have year 0 here. How much is the okay? How much is the
1,005.
initial investments?
1,005.
Okay, they are keeping 3 zeros, isn't it?
Yes.
Okay, this will be 10%, isn't it? Okay, so we have 1,005. We have year 1, year 2, year 3, year 4. So we'll be looking at how to do workings to get those figures now. So you come to your workings here now. So we have our workings here. So our workings here now, we have
This is
so we have the sales now. So we have our years here. We have our what? Year 1, 2, 3, 4. Okay, so I'll be having the sales figure over here. Okay, then what is the sales for each of them? Year 1 is what?
year 1 is 725.
725.
5.
Okay, so we have
765.
765.
885.
Okay, 885.
612.
6 what?
12.
Okay, then we come to the inflation here. How do we inflate it? Please pay attention to this one.
4% per
Okay.
year.
So all these things are in what? All these things are in what? They are in current terms. Okay, so
Current.
this 765 that we are estimating for the 2 years is now. So if it is now, that means that we are going to be having increase of 2 years. Okay, so if this is now, what we are going to be doing is this one. Pay attention to this one. Okay, we are estimating this in what? We are estimating this in what? In 2 years' time. So if this is now the value in the first year, what would have been the value in the second year? If this is now, this will increase by 4% in the first year. It will increase by additional 4% again. So that will be 2 increments. So this is what we do. You come here and have your 1.04 exponent what? 1.
1.
1.04 exponent what?
2.
2. 1.04 exponent what?
Right.
And 1.04 exponent what?
Mm.
Exponent 4. Okay. So you have to pay attention to this one. Okay. They are going to be, all these prices are in current terms. So the 765 is an amount that we are estimating today that we are going to be incurring in the future. So if this particular amount will be increasing by 4%, if we are saying that, okay, the today's value of that amount that we are going to be spending is 765, this amount is going to be increasing by what? By 4% every year. So first year it will increase by 0.4, second year it will be increased by 0.4. Don't go and be multiplying each of them by 1.04, 1.04. No, they are all in current terms. So we are saying that today we are going to be spending 765, but this amount will be spent in 2 years' time. But we are saying that today's expenditure is 765, and this will be spent in what, 2 years' time, and it will be increasing at what, 4% every year. So it will increase it 2 times. That's why we are doing this like this. Yes, Nakafi, your hand is up.
The project 6 that we are calculating for. I think there is a statement that what we are doing right now with the inflation. I don't know if the English that is worrying me because they said project 6 cash flows are exclusive of inflation
At the rate of what?
at the rate of
4%.
4% a year.
Okay, they are exclusive. Inflation is not part. It means that we are projecting these particular cash flows in what? In current terms without taking into consideration the inflation.
Okay.
So these particular cash flows are exclusive of what? Of inflation. So we are estimating them today in current terms. We are saying that today's value, okay, as of today, the amount that we are going to be getting for the second year is 765. We haven't taken into consideration inflation, but the inflation is 4% every year. So it means that before we can get to the second year, we have to experience inflation for 2 times. So what they are trying to say is that these particular prices are what? Are estimated in what? In current terms. These are estimated in current terms. But if they are just giving you this amount, then it means that they are in nominal value. So we have taken into consideration the impact of inflation. But these values are in current terms. Okay, so we want to include them to be in that particular one. So that's how you go about it. Okay. If it should be about this one, what is what you are going to be doing. If it should be the same amount, 100 every year, it's the same thing that you'll be doing last 1.1 exponent 1, 1.1 exponent 2, isn't it? If it should be 100, you'll be increasing it every year by 4%. Is that not the case?
Yes, sir.
It's the same thing over here, but what we do over here is that just that the cash flows are different, but the increment, the inflation will still be the same. It will increase by 2 years before we come to the 765. That is how it is being done. Okay, what is the cost? Let's look at the cost figures now.
Was 145 for year 1.
145 for what?
Year 1.
Okay,
168.
Yeah, hello.
yes, please.
202. And then 94.
Year 3 is what?
202.
20,
2.
and year
And
5
then
is what?
94. 94.
94. So this one, the inflation is what?
5%.
Okay,
5%.
so you have 1.05 exponent 1, 1.05 exponent what? 2, 1.05 exponent 3, and 1.05 exponent 4. So what are we getting for? Let's find the answer and find our what? Our cash flows now.
The first is 754.
For which one?
This is year 1.
Okay, 7.
54.
There's no point
Year
on
2.
Year 2 is 827.42.
827.4.
2.
Okay. Year 3 is what?
Year 3,
Yeah.
5.5.
Year 3 is
995.
995. Okay. Year 4 is what?
Year 715.95.
715.95.
0.95.
Okay. Let's come to the cost.
152.25.
152.25.
185.22.
185 point what? 22.
233.84.
233.84. Okay.
114.26.
1
114.26.
0.26. So let's now find the net cash flow. What will be the net cash flow from each of them?
Year 1 is 601.275.
Okay. Year 2 is what?
642.2.
642.2. Okay.
723.38.
723. Okay.
601.
7 6.
609. 601.69.
No, I want the third year. 601.69. The third year is what?
761.66.
761 points. Okay. So these are the net cash flows that we are going to be discounting now. So after doing these workings, you just bring those cash flows there. Year 1 will be 601.75. Would that give us 0.909? 10%. So we have 642.20. We have 716.66. And year 4. There's no residual value there, isn't it? So what are the discount factors? What are we having for?
Year 2, 0.826.
0.826.
0.751.
0.751.
0.683.
0.683. Okay, so what will be the cash flows? Fast. Let's move on.
Five four 6.99.
54.
6.99.
Okay, what are we having?
Year 3 is 572.01.
Year 3.
Yes.
Year 2 is 530.46.
Okay, 572.01. Year 2 is what?
530.46.
530.46. Year 4 is what?
10.95.
Isn't it 3 again?
410.95.
410.95. So what is the MPV?
560.41.
56.
0.4.
Okay. 560.41. Okay. So they are saying that we should now rank the what? What are they asking us to do? We should now, so we have done the present value, the optimal investment combination given the capital constraint. Okay, they are saying that all the projects are divisible, isn't it?
Yes.
So if the projects are divisible, what we do is we use what we call the profitability index. What does it mean? Return that we look at the return that each of the projects will be given to us. So we now rank the project based on profitability index. Okay, so we look at this one based on the profitability index. So the profitability index, we are just looking for the return. Okay, you cannot say that you are going for the project with the highest what NPV. No, because the money that you are going to be using on that project is not the same for all the projects, and their useful life are also not the same. So we cannot come here and base it on the NPV and say we are selecting the project with the highest one. So you cannot come here and say that, okay, you are going to be selecting project 4 because it's giving you 840. No. How can you compare a project that is having an initial investment of 1,850 with a project that is having 750 as initial investment and is giving you 325, and you are saying that you are going for the project that is giving, no, the amounts that we are investing in each of them are not the same. So what we do is that we cannot compare or we cannot make decisions based on the NPV. We have to find a common ground, a common basis for them. And the common basis is, okay, if I'm using 1,000 to get 390, what is the percentage of return on that particular investment? If I'm using 750 to get 325, what is the percentage of return? So I'll look at the return that the project is giving. I can now use that one as the basis. So the profitability index, we are just trying to calculate the return on each of the projects or the number of times that the project can pay the initial investment. So we look at the first project, which will be project 1. Okay, we are investing how much? Project 1, we are investing
1,000.
1,000, and the return that it is giving to us is what?
390.
So what is the
390.
percentage of the return? So we do the 390, which is the NPV divided by 1,000. That will give us 39%, isn't it?
Yeah, 0.39.
So you just leave it as decimals, 0.39. So you count to your project 2. Okay, so I'll count to project 2 over here. So we count to our project 2.
325.750.
Project 2 will give us, what are we having?
325.750.
325 divided by,
750.
okay, what are we getting?
0.433.
0.433. Okay, let's count to project 3.
590 or 1125.
590. 590 on 1125. What are we getting?
0.524.
0.524. Okay. Project 4 is what?
840 on 1850.
840.
1850.
1850. What is it giving us?
0.454.
0.454. Okay. Project 5 is what?
635 1,300.
63.
5.
635 on
1,300.
1,300. What is it giving us?
0.488.
0.488. And the project 6 now? is giving us 560 divided by
1,500.
1,500. What are we getting?
0.373.
0.373. So let's come to the project combination now. So we now what? Select the project based on the return. Okay. So sometimes the question can ask you to calculate the resultant NPV. Okay, I'm sure that is the C part. But the resulting net present value in B above. So we are just looking at the project, the selection of the project here. Okay, so we have project over here, and we have their initial investments. Okay, so we have, which of the projects are we picking first?
Project 3.
Okay, three is what, 590, isn't it?
Yes.
Please, as you are selecting the project, you have to be looking at what they are telling you. They are saying that
The cost is
Initial investment is 1,125.
1125.
Okay. If you are selecting a project, you have to pay attention to this one. Project 1, 2, 3, 5, and 6 are all independent, but project 2 and 4 are mutually exclusive. So you cannot undertake project 2 and 4 at the same time. So you have to pay attention to that particular one. So that will give us 1125. So we have 1125, keeping 3 zeros at the top. What will be the next project?
Next one is project 5.
Okay. So we have project 5 now. What is the initial investment?
The initial investment is 1,300.
1,300. How much will be left? We have 5,000 as the full amount. So minus 1125.
22575.
22575.
2575.
Okay, 2575. Okay. So the next project will be what?
Project 4.
Project 4. Okay.
Yes.
Project 4, how much are we spending there?
1,850.
1,850.
1,850. How much will be left?
725.
725.
Okay. What will be the next
We will
project?
take project 1. Part of project 1.
So which one should be the next one?
Part of project 1.
But the next one should be project 2, isn't it?
Project 2.
But
But they
Yes.
say they
but
are
because of
mutually
the
exclusive.
mutual,
So the two of them cannot happen at the same time. So we now pick project 1. So you cannot undertake project 2 and 4 at the same time. You will undertake only 1. So because of that, we are ignoring project 2. Then we come to project 6 and 1, and we pick the 1 because of the 0.39. So we come to project 1. Okay.
now the 725.
So, but how much is needed for that one?
1,000.
It's 1,000. So we can only invest 725, so that we have our total of what? 5,000. So they are asking you to calculate the resulting what? NPV. Resulting NPV. The resulting NPV. Resulting NPV. You have your project over here. Then you have your NPV over here. Keeping 3 zeros. So the first project that we are bringing is what? Project 3. Okay, project 3. What is the NPV of project 3?
590.
Okay, 590. Project 5. What is the NPV for project 5?
635.
635. Project 4. What is the NPV?
840.
840. Project 1. We are not investing all of them, isn't it?
So project 1 is 282.75.
It's 2.
82.75.
725 divided by 1,000 multiplied by what?
390.
Okay. So the 1,000 is giving us 390. If you invest 1,000, you get 390, but you are investing only 725. So you find the portion of the NPV that the 390 of the NPV here is 4,000, but we are investing only 725. We are investing only what? 725. So how much will be the money there? So you do 725 over 1,000 multiplied by 390. What are you getting?
282.75.
282.
0.75. So you can do it 283 because we are running to the finale.
Now we have 3 zeros at the top. So what is the total?
Two, 347.75. 47.75.
Okay, 2347.75. So that's how we go about the okay. So sensitivity analysis, we have solved this question in class already. Let's do something on leasing and also asset replacement. Let's do that too. Leasing and asset replacement. Let's do that too. Okay. So take the lease or buy for us. The 4.
Question 4.
Yeah.
Kobe Limited is about to replace its existing delivery vehicle with a new design of a vehicle that offers greater fuel economy. The company estimates that replacing the existing vehicle will save running costs of 200,000 Ghana cedis per year. There are 2 financing options available. Option 1, borrowing funds and purchasing the vehicle. The vehicle could be purchased for 3,400,000 Ghana cedis using a bank loan with an after-tax cost of borrowing of 4% per year. The vehicle would have a useful life of 4 years and would have a residual value of 1,400,000 Ghana cedis at the end of that period. Straight-line tax allowable depreciation is available on the vehicle. The vehicle will be subject to a special tax of 60,000 Ghana cedis at the end of each year of operation. The tax expenses are corporation tax deductible. Option 2, leasing the vehicle. The vehicle could be leased for a period of 4 years for a payment of 600,000 cedis per year, payable at the start of each year. The leaser will pay the special tax. These payments are a corporation tax deductible expense. The firm after-tax weighted average cost of capital is 8%. The company pays corporation tax at a rate of 30% 1 year in arrears. Required. Advise Kobe Limited on whether it should lease or borrow to finance the new vehicle. E. Examine 3 reasons other than possible after-tax cost advantages why Kobe Limited may choose to lease rather than buy the new delivery vehicle. Thank you.
Okay. So they are saying that the company is about to replace what? Its existing delivery vehicle with a new design of vehicle that offers greater fuel economy. The company estimates that replacing the existing vehicle will save what? Running cost of what? 200,000 per year. There are 2 options. What you have to know is that whether you are leasing or you are buying, the cost savings will still be the same, isn't it? Whether you are leasing or you are buying, the cost savings in 4 will still be 200,000. Is that correct?
Yes, sir.
Okay. So whether you are leasing or you are buying, the cost savings will still be what? Will still be 200,000. So what you can do is that will be having the same effect for the 2, but we can still bring them when we are doing our issues for leasing and those ones. So whether you are replacing the vehicle by what? By buying it or leasing a different one to replace the new one, the one that you are going to be bringing will be giving you a cost savings of what? Of 200,000 per year. there are two financing options available. Option one, we want to borrow funds and purchase the vehicle. So we want to buy the vehicle or release. Okay, the vehicle could be purchased for what? 3.4 million using a bank loan with an after-tax cost of borrowing rate of 4%. What we do is that mostly the financing option, if you come to lease or buy, the financing option, we assume that we are taking the money, we are financing the purchase with what? A bank loan. So we use the cost of capital will be the bank what? The rate of what? Borrowing. So that's what we use. Okay. The vehicle would have a useful life of 4 years and will have a residual value of what? 1.4 million at the end of that period. Straight line tax allowable depreciation is available on the vehicle. The vehicle will be subject to a special tax of 60 at the end of each year of operation. The tax expenses are corporation tax deductible. Option 2, leasing the vehicle. The vehicle could be leased for a period of 4 years for a payment of what? 600,000 per year, payable at the start of each year. We are paying in advance. The lessor will pay the special tax. There's no special tax on this one. Lessor will pay. Lease payments are corporation tax deductible expense. The firm after tax weighted average cost of capital is 8%. The company pays what? Corporation tax at a rate of what? 30% 1 year in arrears. So we are looking at whether we want to buy or we want to lease. Okay, I'm saying that whether you are leasing or you are buying, the core savings will still be what? Will still be the same. So since the core savings will still be the same, it means that this core savings will not be part of what? The issues that you have to consider when you are making a decision. Anyways, you can include it. You can include the core savings. It's a benefit that is coming in. You can include the core savings. You can also ignore it because there will not be any change in the core savings if you are using the two options. Whether you are replacing or not, you will still be saving a cost of 200. Whether you are not replacing, you are leasing, you will still be making a core savings of 200,000. So we are going to be excluding the core savings because it's going to be having the same impact. Okay, or we can actually increase or can actually include it again. Any of them that you want us to do, we are good to go. But we are using time, so you can leave the core savings because whether you are looking for the financing or replacing, you are going to be incurring the core savings. The core savings will be a benefit to you, which you are going to be paying tax on it. That is not going to be any problem. It is a core savings that is even telling you that you should go and buy or you should replace the machine. So we are not going to be including it because it's going to be having a zero effect. If you include it, it will be an income to leasing at the same time income to the buying. The tax charge will be the same. We are going to be paying tax on this core service, a cash flow, we pay tax on it. And the tax payment will still be the same. So we ignore this one because we don't have time. Okay, so let's come to the cost of what? So we come here and I'll have the buying option. Okay, so we have the buying option. So we have our statement here, the buying option, we have the years over here. We have year 0. This one will last for how many years? The machine has a useful life of 4 years, isn't it?
4 years.
Okay. So we have this one to be 1, 2, 3, 4, 5. I hope someone can understand why we are writing 5. Okay. The tax
Yes.
is paid in what? In arrears. Are you okay? So your tax benefit will also be enjoyed in arrears. Okay. So let's come to this place. We have the years. Now let's come to the cash flow. What are the cash flows? What are the cash flows that will be coming in as a result of this one? What are the cash flows that will be coming in? The vehicle could be purchased. That will be year 0. And the vehicle will have a useful life of 4 years and will have a residual value of what? 1,400 at the end of that period. So we can have a residual value now, isn't it? Okay. So the first one, we
Yes, sir.
can bring a residual value. You don't have to arrange them in any order. Okay. We are not doing cash flow statement where you will be saying that, okay, you have to show your cash flow before you add this one. Okay. This one is going to be any order. We are not doing revenue. We are not doing sales and those ones. Okay. If you are doing cash flow statement where you have revenue and cost, that is why you do all of them to know your cash flow from the operating activities because before you add the ones from the investing activities. So we have the residual value. That will be how much? 1.4 at the end of what? Year 4, isn't it?
Yes, sir.
Okay. We are also going to be making some payments relating to what? Special tax, isn't it?
Yes,
Okay.
sir.
So special tax is a payment that we are going to be making. So we have special tax is a payment that we are going to be making. So 60,000 at the end of what? Every year, at
Every
the
year.
end of every operation. And that will give us 60, isn't it? Okay. They are saying that that is what tax deductible. It is tax deductible. So we come and we will calculate the tax interest on this one and what we bring it over there. Okay. So this is tax deductible. So let's come here. What will be the payment that we are going to be making again? Is there any other payments that we have to make relating to this particular one? Is there any payment that we are going to be making relating to this one again? Is there any cash outflow relating to the purchasing? We have the special tax and the initial amount. We count the initial amount there. Okay, there's no other benefit over there. We have done the residual value already. But this is what we are going to be doing. So this is going to be taxed. The depreciation, we are getting taxed on depreciation. So we calculate the tax benefits. So I have the question number what? Question number 4, that will be Kubi Limited. So question number 4. Kubi Limited. So question number 4 for the Kubi Limited, we now come to tax benefits. So we calculate the tax benefits the way we have been calculating it. So it is a tax authority that will give you the tax benefits. So how do we calculate tax benefits? Let's come here. We have the years. Okay, we have the years now. We have our cost over here. We have our depreciation. Then we have our what? Our tax benefit over here. So year 1, what are we having? Year 1, what will be the depreciation? 4 years.
$850,000.
850. Are you calculating it based on your own depreciation or which one? Are you calculating it on the depreciation of the entity or the depreciation of the tax authority? Which of them?
I'm calculating it on the straight line like basis. That's
The
um,
cost,
the
the
number of
cost minus what?
cost.
Then I'm waiting for a response.
So if the entity one, if you subtract the residual value from the cost and you divide it by the number of useful years, that one you get 500,000.
If you are doing what?
Hello.
Yeah.
So if you subtract the residual value from the cost, that's the purchase price of the asset, and you divide it by 4, you get 500,000.
Okay.
That being your depreciation or depreciable amount.
Okay. But okay, this one you can do it from the perspective of the tax authority, or you can do it from the perspective of the what? Of the entity itself. Okay. But we are going to be calculating it from the perspective of the tax authority. This is what we are going to be doing. Okay. So this could be the machine could be purchased 3,400 using a bank loan with after tax cost of what? Borrowing of 4% per year. Okay, the vehicle will have a useful life of 4 years and will have a residual value of this particular amount. Okay, straight line tax allowable depreciation is available on the what? On the vehicle. The vehicle will be subject to a special tax of 60,000 at the end of each year of operation. The tax expense are co-operation tax deductible. Okay, who is going to be giving you what? Who is going to be giving you the tax allowable depreciation?
The tax authorities.
Okay, so we calculate the depreciation from the perspective of the tax authority. Okay, if the tax authority is not calculating depreciation, they don't factor in what? They don't factor in the residual value until the residual value has been realized. That's how they do it. So what they'll do is that the depreciation for every year will be this figure for them. So they come here, they have 3,400 divided by 4. That will be the depreciation that the tax authority will be giving to them every year. So the residual value has now been realized. So we have 3,400 divided by 4. What is the depreciation that we are getting every year?
850,000.
850,000. Okay. This 850,000 now, we are not going to be paying tax on it. So what is the tax benefit on that particular amount? What is the tax benefit on it?
255.
So we have 255. So year 2, we are still going to be there. This figure will still be 850 because straight line, isn't it?
Yes.
Okay. Year 3 will also be what? The same thing. So year 3, this will also be 850. Then this will now be 255, isn't it?
Yes.
Okay. Year 4, what the tax authority will do is this one. Okay. Year 4, what the tax authority will do is this one. Okay. What will be the carrying value in the books of the tax authority?
$850.
850.
That will be 850, isn't it?
Yes.
Okay. So the carrying value in the books of the tax authority will be 850. What they will do for you is that, okay, you are going to be selling the asset for what?
1,400.
Okay. So they will give you capital allowance on this full amount. Okay. But since you are going to be selling the asset, which is 1,400, okay, you should have paid tax on all the 1,400, but this is what they are going to be doing. This is what they will do. Okay. They will say that we are going to be giving you capital allowance on 850. So what they will do, they net this particular amount. The difference now will just be a tax deductible amount, or it will be what? A capital allowance given to you again. So you are going to be having, so let me come over here. This will give us the difference over here. Let's have the cost of the asset at the end of every year. So 3,400 minus 850. We have 255.
550.
Okay, and this will be 1,700.
1,700.
And year 4 will be what? 850. Okay, they will give you capital allowance on 850, but you are selling the asset for 1,400. So you enjoy capital allowance on the 850, and you pay tax on what? on the 1,400. So what would be the net tax that you are paying? What would be the net tax that you are paying?
$165.
You'll be paying tax on what? On a negative figure of 550, isn't it?
Yes.
So you are paying a tax of 165. This will not be a tax benefit to you. This is what the tax authority will do for you. Okay, this is how the tax authority will give you the capital allowance. So you always calculate the capital allowance from the perspective of the tax authority, the tax benefits from the perspective of the tax authority. But if you want to do it from your own perspective, then you have to add the depreciation back and subtract it, add it back and subtract it. Okay. If you also want to do it, you'll be getting the same answer at the end. But what is going to happen is that it's going to be different. Okay. If you are calculating the depreciation on the asset on a normal basis, you are going to be having 3,400 minus 1,400 divided by 4, isn't it? What are you getting?
500,000.
Okay, you get 500,000. So this 500,000, you enjoy tax benefit of 30% on it. What are you getting?
$150.
Okay, 150 for 4 years, isn't it?
Yes.
That will give you 600. Add this one also and see what you are going to be getting. Add all of them.
600.
Okay. But you can see that the way the tax authority is giving you the benefit is different from what you are going to be doing. We are not looking at your own depreciation. It is the tax benefit that you are, the tax benefit. The tax authority is the one charging you the tax. So the benefit that they are giving on the depreciation is the what? Is the cash flow for you. So you are estimating the depreciation, and that they are now saying that you should have been paying tax on the full amount. But they are saying that, okay, because of this asset is what is a capital asset, we are going to reduce your tax liability by this amount. So it is the capital allowance that is now bringing in the cash inflow. Okay, so let's take it from this one. If your profit is, you are using cash flow, you should have been paying tax on what? 0.3 on this amount. Okay, but so if you are paying the tax, how much are you going to pay as a tax on the 2,500? If that is your cash profit.
750.
Okay, you'll be paying a tax of 750. The tax authority is now telling you that since this is a depreciable asset, we give you a capital allowance of 500. So it means that you pay tax on only what? 2,000. That will give us how much?
600.
Okay. What is happening now? You can see that there's a cash inflow of 150 to you. Instead of you paying 750, you are now paying what? 600, isn't it?
Yes.
Okay.
Yeah.
Is it your own depreciation calculation that is bringing the 150?
No.
It is the tax authority, isn't it? So
Yes.
it's not your own accounting depreciation that will be bringing in the tax benefit as a form of cash flow. It is the capital allowance that the tax authority is giving to you. So if they are saying that this is tax deductible, it is important and very necessary to calculate it from the perspective of the tax authority, because they are going to be giving you the capital allowance, not yourself. You can't grant yourself capital allowance. So this is how we do the capital allowance over here on the what? On the asset itself. We come to the tax benefit on the tax expense. The question is saying that the tax expense will be tax deductible. What it means is that we are going to be subtracting it from our profit before we charge tax. So there will be a tax benefit. It is going to be reducing our tax liability. So that is a tax benefit. So we come here, that will be 0.3 multiplied by 60. What are we having?
$18.
That will give us 18 every year, isn't it?
Yeah.
Okay, we are paying this 60 every year. We are paying the 60 every year. This is a 60 over here. So it is tax deductible. So you enjoy tax benefit on it. So you are paying what 18 every year. So what will be your total tax benefit in the first year?
Yeah, the tax isn't not in arrears.
Yes, that's what I'm asking. What will be your tax benefit in the first year? Mention the figure. There we go. What will be your total tax benefit in the first year? 18 plus any of these figures. What are you getting?
273.
Okay. So the tax benefit for the first year will be 273. But these taxes are paid in arrears. So you come over here, your
So
tax
the
benefit.
specific tax will also be in arrears.
That's why we are adding to have 273. Are you okay?
No, the specific tax.
No, the special tax, you are paying this at the end of every operation. At the end of every operation. Okay, so the
Okay.
special tax that you are paying, that one you are paying at the end of every year, it's not your own tax that you are paying. You are paying the tax on the what? On the use of the what? On the vehicle. Okay, on the use of the vehicle. So they are saying that this vehicle will be subject to a special tax of what 60,000 at the end of each year of operation. So you are going to be paying this amount at the end of each year. It's not a tax that you are paying on your own operations. It's a tax that you are paying on the vehicle. The tax that you are paying in arrears is the what? Is a tax on your normal operations. The tax that you are paying on your profit. Okay. So if you are paying tax in arrears, what it means is that you are not going to be paying withholding tax in arrears. Withholding tax is not a tax on your normal operations. The only tax that we are talking you are paying in arrears is your cooperation tax. It is your cooperation tax, not the tax that you are, other taxes that you are paying. No, it is your cooperation tax. Okay. The company pays cooperation what? The companies pay cooperation tax at rate of 30% 1 year in what? In arrears. The tax that will be paid in arrears will always be a cooperation tax, not other small taxes. No. Okay. You cannot say you are withholding a tax because you are paying your corporation tax in arrears. You are withholding to you leave it for that particular. So this one there will not be anyone. You come here, you have 273 as a benefit. Okay. This will also be 273 as what? As inflow. This will also be 273 as inflow. But the last year will give us what?
Negative 147.
So 165 against what? 18. Okay, negative 147. So we have negative 147. Okay. What again? We are agreed that we are not bringing the what? The 200,000, isn't it? Okay. We agree that we are not bringing the 200,000. So we now look at our cash inflows. So we have negative 60 here. This will be dash. This will give us what? 213. This will also give us 213. This will also give us no, sorry. That will give us 1613. I hope that is correct over there. And this will give us 147. So we come to, okay, let's not total this for now. Okay, let's not total this for now. So we come to our initial cost. Initial cost is 3,400. So we have dash, 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 dash. So we can now total and have 3,400. And we have 60 here. We have 213 here as positive. We have 213 here as positive. We have 1613 here and 147. So we now discount using what 4%, isn't it? Okay. So you forget about this one. If you are doing lease or buy, we use the what after tax borrowing rate. We assume that you are going to be buying this one by what? Borrowing money from what? From a bank. So we are using 4%. Please get those figures for us, then we put it over there and move on.
Your one is
0.962.
0.962. Okay, 0.962.
0.925.
0.925.
Okay, 0.9.
25.
Okay, 0.925.
0.889.
0.925. 0.889.
889.
Okay, 0.889.
0.855.
0.855. Okay,
And 822.
0.823.
0.
822.
822.
Okay, 0.822.
Yeah, 157.72.
7.72.
57.
0.72.
So this will give us 3,400. 57 point what?
72.
17.
Okay,
197.03.
197 point what? 03. That will be
03.
positive.
Yes.
Okay,
189.36.
189.
0.36.
189.36.
One three seven 9.12.
189.
1379.
79 point what?
12.
12.
120.83.
120.
Negative 0.83.
0.83. So you just find your MPV now for these ones and put them together. Then you go and do, so you put MPV together, you put all the MPV together. Let's come to the leasing option. So if you want to lease, what is the cost? Let's have our years over here. Our 0, 1, 2, 3, 4, 5. So we have our currencies over here.
So year 0 will be 600.
Okay, so the lease payments, we are paying in advance,
And the
isn't it?
stock, yes,
Okay, so the first payment will be made now. The second one will be here. The third one will be here. And the fourth one will be here. Okay, so we have dash dash. Okay, so what they are saying is that with this particular one, the special tax will be paid by what?
The leaser.
The special tax will be paid by what?
the lessor.
So the lessor will pay the what? The special tax. So it means that the system should not come there.
Mm.
Okay, the system will not come there. So the lessor will pay that particular one. So it means that we are not going to be paying any expense under this one, isn't it? The entity will not incur any other expense apart from the lease payment, isn't it?
This payment
These payments are corporation tax deductible
tax
Yeah,
expense.
so that one is a benefit to us, but we are looking at payments. Are we paying any amount apart from the lease payment?
No.
No.
Okay. Sometimes they can also give you that the company will still pay the maintenance cost. Okay. So if the lease payments are tax deductible, it means that they will be giving us what? 30% what? 30% what? Allowance on this particular one, isn't it?
Yes.
So calculate that one. Let's move on and see. So let's calculate what the tax benefit.
180.
Tax benefit on the lease. That will give us 0.3 multiplied by the 600. That will give us what?
180.
180. This 180 will be enjoyed in what?
1
Payable
year.
at the start of each year.
Okay, that will be in arrears. So
Payment.
it will be enjoyed at the end of every year. When do you pay tax? It's at the end of every year. So the first
Yes.
year will be at the end of the every year. But since you are paying the tax in arrears, your benefit will also be in arrears. So instead of you starting from year one, you will now start from year what? Year two. Okay. So the lease payment, the tax benefit will be given to you at the end of year one. But since you are paying tax in what? In arrears, they will allow you to subtract that particular benefit also from the tax, the way you are what? You are paying the tax. So the benefit, the tax benefit is what? Is treated the way you are paying the what? The tax. Is treated the way you are paying what? You are paying the tax. Okay. So this is what we are going to be doing over here. So we have 600 over here, 600 over here. Then this will give us what?
420.
420, 420, 420. Sorry,
180.
180
40.
and 180. Okay. So we have our discount factor here to be 4%. So you also
8%.
discount. No, we use the same rate for all of them. We discount all of them with the same rate. Okay. We discount
So
all.
they say the firm after tax weighted average cost of capital is 8%.
That's why it's a question. Okay. That makes it to be a question. Because you cannot just stand up and start working without thinking. Okay. That makes it a question. So yes, it's not that the person is weak.
But the
Okay.
borrowing, this one is the bank that they okay. So the least they have to take the money from the bank. That's
Now,
why it's
now that you are talking. Okay. I like the way you are talking now. So it means that everything is going to be financed with what? With a bank loan. So the least two, we are going to be using a bank loan to pay. Are you okay now?
okay.
Okay. So you
Thank you.
discount them and compare the two MPVs. The one that is okay, you go by that particular one. That is the issue about what? About the lease or the buy. The lease or buy issue. The lease or buy issue. It's a very simple exercise over there. Okay. This Mabrel. Okay.
Please, I have a question.
Okay.
And please, concerning the lease or buy the rate, please, what I know is that most of the times when we are discounting it, we are to use the pre-tax rate. And then I'm asking, is it because
We don't use pre-tax. We always use after tax.
we use after tax?
Yes, yes. Then you have to check again.
Okay,
Okay.
and thank you.
All right. All right. We always use after tax unless the question is asking you to use pre-tax. Apart from that one, you have to use the after tax. I'm sure there was a question. There was a question on lease or buy before. Maybe I don't know which year is that. Maybe I can actually.
Thank you. Please, now check.
Okay. Okay.
Abanga,
Yes.
are you there?
And then
Okay.
hope it's going well.
Yes. So.
Yeah.
Where are you right?
Tema.
Oh, I'm also writing at Tema.
Okay, then we'll meet on Tuesday.